Hello, and welcome to day one of the Moss Adams Private Foundation virtual conference. We are pleased that you're able to join us. We do have 4 sessions today, totaling 5.5 CPE credits for today's portion of the conference. Per the National Association of State Boards of Accountancy, to qualify for these credits, you must attend the 1 credit sessions for a minimum of 50 minutes and respond to at least 3 of the polling questions. And for the sessions offering 1.5 credits, you must attend for a minimum of 75 minutes and respond to at least 5 of the 6 polling questions. And then if you meet all of those requirements, your certificate will be emailed out within 3 weeks. And before we get started, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, there is a link to the full agenda in your handouts window, and during the 45-minute break, we will be switching to the afternoon sessions. There is a link in your console that will take you directly to the afternoon sessions. However, if you have any trouble with that link, you can also find it in your email and calendar appointments, so plenty of ways to get to the next console. And now I would like to turn it over to Wendy Campos, partner and Foundation's National Practice Leader, to get the conference started. Wendy?
Great, thank you, Amy. Good morning, and thank you for joining us for the Moss Adams Private Foundation Conference. We're excited to have you for our 3rd annual event. We have a great agenda planned with a fantastic lineup of speakers this year, and hope you're all looking forward to it. I'd like to introduce our first session. We're going to kick it off. Get our pictures up there so you can see everyone. We're going to kick it off with a discussion on self-dealing for private foundations, followed by a discussion with real-life transactions and scenarios from the perspective of an attorney, Danika Mendrygal, a CPA, myself, and an in-house, she works side by side with in-house counsel as the head of finance at a foundation and is now also practicing with Danika, Misty Burns. With that, let's kick it off and get started. Just a quick agenda of what we're going to talk about today. I alluded to this already, but we're going to go through just some basics and technical and give you a good reminder on the self-dealing rules. We're going to have a panel discussion with some examples, some tips and tricks, and then we're going to talk about correction and remedies. All right, we're going to start off with a polling question. We want to kind of get an idea of the audience. So give us an idea of what your role is. Are you with a foundation on the program side, foundation board member or trustee, with a foundation in finance or management, or other? And we'll give just a little bit of time for the polling questions. And I said other. Service provider was our 4th option, but also other, because you could be not with a foundation and not a service provider either. How are we doing, Amy, on the poll results?
It looks like quite a few have responded. I do want to let the audience know that you need to make sure to hit that submit button. Otherwise, it will not register for your CPE. So click the response that you would like and then make sure to hit submit. All right, here are the results.
All right, it looks like most are foundation finance and management, about 55%. Well, I think this session is going to be very relevant. I think it's relevant for anyone working within a private foundation, even in the program area, but I think that this will be especially relevant for those in finance and management who probably would have to deal with one of these transactions if it were to occur. All right. Just want to kind of give a quick review of private foundation excise taxes, even though we're really going to focus on number one, self-dealing during this session. We do have some other sessions that will touch on some of these other excise taxes, but just a quick recap. Self-dealing, that's transactions between private foundations and disqualified persons, and we'll talk about who those individuals or corporations, partnerships, et cetera, are. Failure to distribute income, as you know, private foundations have a minimum distribution requirement that they have to meet. Excess business holdings, jeopardizing the investments of a private foundation, and taxable expenditures. Again, we're really focusing here on self-dealing. I want to give you an understanding of self-dealing. It's a prohibited transaction between a disqualified person and a private foundation. Both the disqualified person and a foundation manager can be penalized. So we will talk about this when we get to correction, but just keep in mind that this is not a tax that a private foundation would pay. This is a tax on that disqualified person or foundation manager. The IRS cannot abate the self-dealing penalty due to reasonable cause, and mistakes do not relieve the penalty assessment. And we're going to talk about the definition of a disqualified person because that is key when you're looking at whether a self-dealing transaction has occurred.
And Wendy, if I can jump in here,
absolutely.
Add maybe a little bit of context or framework that we find is really helpful with our clients. I think it's important to view this entire self-dealing conversation, if you are new to it or less familiar with it, to view it through the lens of understanding that the goal of these rules and really all of the private foundation rules, chapter 41, 42, is that of deterrence, right? It's focused on don't do it, stay away from it. And if you do it, here is just how hard your hand will be slapped, right? So that framework and that lens, I think, is really key, because if you come at it from the perspective of what is best for a foundation or what is fair or what is fair market, you may not end up at the same answer. So I just toss that little context in.
Great insight. Thank you very much, Danika. I do have a quick slide here of the tax return. And the reason that I like to include this very early on when talking about self-dealing is because there are many questions on a private foundation's tax return. And we call them here at Moss Adams trigger questions to determine if you've entered into any transactions or activities that could cause an excise tax or that could be a problem. And my point here is it's a very transparent form. As we all know, tax-exempt organizations in general are really not, private foundations do pay a net investment income tax, but there's also a lot of disclosure information and a lot of transparency of tax-exempt sector in terms of your annual compliance filing. So I like to point out that there are questions right very early on in the tax return about these types of transactions. So if you're really digging in and providing to your CPA, for example, tax provider, or you're preparing your return on your own, really digging into what's been going on, you're going to surface one of these transactions. And we'll talk later, as I already mentioned, about correction, but really reporting is a voluntary reporting, because you're going to be the one to know a transaction happened, or if the IRS were to audit the private foundation, that's another way that a transaction could get discovered. and have to be reported. And you don't want it to get to that point. And again, we will talk about all of this later, but just wanted to mention the tax return side of it in terms of your activities each year. All right. We absolutely need to talk about disqualified persons and the categories of disqualified persons, because that obviously is key, again, in determining if a self-dealing transaction has happened. So a disqualified person could be an individual, it could be a corporation, a partnership, a trust, an estate, or another private foundation. It could be a substantial contributor to the foundation, a foundation manager, which generally is an officer, director, or trustee of the private foundation, or an individual having similar powers or responsibilities. One thing that we've had with a couple of clients over the recent years is really digging into the staff and determining if they meet that foundation manager category from the perspective of a disqualified person. They might be a foundation manager just generally, but when it comes to self-dealing, they may not, your CEO position or CFO may or may not have some of those powers. CEOs usually do, but again, really looking at those organizing documents to see what kind of authority when it comes to your staff. Certain 20% owners of a corporation, partnership, trust, or unincorporated enterprise that is itself a substantial contributor, family members, and this one trips up private foundations often. So this includes an individual's spouse, ancestors, children, grandchildren. So it's a lineal definition. Does not include brothers and sisters. When we get to our examples, we may surface an example where you just want to be cautious of the brothers and sisters, but just keep in mind that family members, that clear definition of, I say clear, nothing's clear in this space, but disqualified person is lineal. And then a corporation or partnership, trust, or estate in which any of the persons above hold more than a 35% interest. And we don't have this on our slide. I'm not sure how it dropped off because we've had it on there when we've used this slide before, but government officials, they are also disqualified persons. Wanted to talk just a little bit more about substantial contributors. This could be an individual, estate, partnership, LLC, association, or corporation, so it doesn't have to be an individual. Contributed or bequeathed the greater of $5,000 or 2% of the total contributions and bequests received since inception of the private foundation. So it's really key that these are tracked. I know when we prepare private foundation returns, we have a work paper to maintain on behalf of our clients that do track the substantial contributors, because again, it's since inception. And then once a substantial contributor, generally always a substantial contributor. And then the creator of a trust is always a substantial contributor, regardless of the amount contributed. All right, I think we're at another polling question. Does your private foundation have procedures to identify and track disqualified persons? Yes or no?
And Wendy, while people are answering that, I saw a question in the Q&A that I thought we could chime in on real briefly, which was whether or not a board member could be a disqualified person. Assuming we're talking about a board member of the board of directors, the answer is yes, and will be and is.
Great, thank you, Danika, for monitoring that and seeing that. Appreciate it.
It might be the only one I catch today, we'll see.
And I'll just speak oh, good, we've got results. But I was just going to say, so good, great, 64.3% do have procedures to identify and track. I was just going to speak to that. That's really important. It's important to know who your disqualified persons are. And if you have new board members come on, that exercise is most likely ongoing and fluid. So you want to continue to update that list and make sure that you know who your disqualified persons are. We've got another polling question. Just want to kind of get some of these in the books right off the bat. does your private foundation have conflict of interest statements signed at least annually by board members and officers? Yes, no, not yet, but we will start doing this.
I like that third option. I mean, I prefer the first option, but for those of them, for
Yes.
those attendees just realizing. I was going to chime in, Wendy, on that last question, talking about tracking DPs. One little extra nuance to that is, gosh, do your lawyers love it when you can hand them that list right up front when you ask the self-dealing questions, instead of us over here trying to recreate and come up with a potential list and list them out for you. So added benefit of efficiency there.
We do have a question in the chat. What are the best practices for procedures to identify and track disqualified persons? And
I'm curious. I know Misty's going to talk about that a little bit when she gets to some of the in-house perspective.
Great. And then another one, so siblings are not disqualified persons unless they are on the board. That is correct, and that actually makes a really good point. Someone could be a disqualified person meeting multiple bullets that I had on that slide previously. And so you do just, if they are a brother or sister, but they're a board member, you're right. The board member role makes them a disqualified person, even though the brother sister role does not. So very good question. I'm glad that was asked.
Well, and to be aware also that when you're looking at complicated family structures, particularly for foundations that have existed for some amount of time and we're moving through generations, you might get caught through some of the other versions as well. So just be aware to look at that full. I mean, I never do a disqualified person analysis or a self-dealing analysis with going back every time to that list and checking every single one, because sometimes there's a surprise built in there for you.
Yeah, and I know we have the results, but I was going to mention one more thing as well, Danika. I know we have helped clients create that list as well, and not just the names, but also why it makes them a disqualified person, I think is helpful in your tracking, so that when you do go back and revisit it, you can see if they're still in that role, and then is there any additional reason they would be a disqualified person, or is there any way they can drop off, et cetera.
Yep, agreed.
All right, we've got our poll results, almost 79%. That is great. Conflict of interest statements, we'll talk about that, but that's a great way to identify if certain transactions are happening, depending on how robust or not your conflict of interest questionnaire is, obviously. All right, we're going to talk about prohibited acts. These are some transactions that could be self-dealing: sale, exchange, or lease of property, lending of money or credit or extension of credit, providing goods, services, or facilities, payment of compensation. And we have a little asterisk here, unless an exception applies. And keep in mind, again, these transactions would be with disqualified persons to constitute a self-dealing transaction. All right, we are going to jump in to some examples. And I kind of want to frame this up before we get into the examples. We've got some examples on the slides. We've got two slides on the examples. And then we're going to roll into some panel discussion on some real life transactions that each of us have dealt with within our client base, or with Misty in terms of her role as head of finance and working side by side with in-house counsel at a private foundation. We're going to try to avoid duplication, but we want to make sure that we give you some of these examples in real life transactions, because they're things that have popped up in the past, or that pop up often, or questions that we get regularly. So some of them are pretty common, some of them maybe not so much, but definitely very relevant in the self-dealing area. All right, so I've got two examples up there so far. Disqualified person sells property to a private foundation, and keep in mind, even if at or below fair market value, yes, that would be a self-dealing transaction. So these rules are not intuitive. They're not There's some of them you might think, well, it's benefiting the private foundation. Why would that be a self-dealing transaction? So just keep that in mind. It's not intuitive. It's not just because it benefits the private foundation, it's okay. And then a disqualified person donates property to a private foundation. That's okay. That's not self-dealing. Now, that might make that person a substantial contributor, depending on the value of that contribution, but it doesn't in itself rise to the level of self-dealing. All right, I'm just trying to get a few that are similar onto the slide so you can see them. So a disqualified person donates property to a private foundation subject to a mortgage. We're going to talk a little more about this in our panel discussion, but this would be a self-dealing transaction. And we'll talk about some different real life scenarios where that could occur, or you wouldn't think about it, but it trips you up in the self-dealing space. A disqualified person rents office space to a private foundation, even if at or below fair market value. That's a self-dealing transaction. And we see this one pop up a lot, especially someone has formed a new foundation, whether it's a corporation that's formed it or a family that's formed it, and they just decide, well, the foundation's operating in some of our space. We're going to charge them a low amount of rent, but some rent so that they're paying their fair share. Again, that's a self-dealing transaction. It just cannot happen. There could be, on the next one, they could donate the office space to the private foundation. You can have a lease agreement that documents the relationship, but it does need to state that it's a zero cost. There's no cost to the private foundation whatsoever.
Wendy, can I chime in on that one? Because
Absolutely.
I often see, and we dealt with this. We had a foundation, was not our client. They came to us much later. They had been doing this. They realized it probably didn't look good. They weren't coming at it from a self-dealing lens at all, but they just realized maybe that's not great. Let's flip it, and that will solve the problem. The foundation will be on the lease, and they'll just lease to the DP. Easy, done. Obviously, that doesn't work as either. And so in that situation, that will lend itself to some correction discussion that we can engage in later. But important to know that goes either way.
Yes, very, very good point. All right, let me get a couple up here on loans. So a disqualified person makes a loan to a private foundation, even if at or below market terms. That would be a self-dealing transaction. However, disqualified person makes a no interest, no fee loan that actually is okay. That's not a self-dealing transaction. There's not very many of these where it makes it okay, but this is one example. Our next few examples, we are going to talk about more extensively in our real life examples, but I'll just touch on them. We're going to talk about fundraising events. If a private foundation receives tickets to a fund, buys tickets, or they give enough, their grant is large enough to where they receive tickets in exchange to arts events or a fundraising event, or there's an auction at a charity event. We're going to talk about some of these things, so I won't spend a lot of time here, but just you have these here on your slide to refer back to as well. All right, let's see what our next, there we go. Okay, this slide talks a little more about grants, and I don't think we have too many real life examples. There might be a little bit of overlap, but I'm going to go through some of these because I think we get these questions a lot. And we even have some private foundation clients where we've gotten the questions a few years after they're established, they started their grant making activities, they're very active, and then they come back to us with the questions again, or new questions framed a little bit differently, because now they're living those real life transactions. So a private foundation makes a grant to a public charity at the direction of disqualified persons on the board, and it's within the private foundation's exempt purpose. That is not a self-dealing transaction. So it is okay that, the board members are, as disqualified persons, are making recommendations on giving grants to certain public charities. Now, if
Wendy,
the private foundation, oh, go ahead. Yes, absolutely.
Sorry. The wonders of panels via Zoom. It's seamless, right? Just maybe for context on this, I think it's important because there's a lot of issues that come in really with this self-dealing arena as a whole, where we're talking about related parties, right, which is going to inherently include disqualified persons. And I think it's important to remember that right now, right, we're talking about self-dealing only. So, for example, that last scenario that Wendy raised, there is a conflict of interest there, and maybe it's not a financial conflict of interest. Maybe it's something more like what we might phrase as an external loyalty, but there might be other issues to consider that could cause a problem, whether it be from best practices with respect to conflicts, with respect to state law, optics, and making sure a transaction looks good, or even other issues to consider with respect to private benefit or private inurement. So I just want to remind everyone that, even as we go through these examples, we're trying to focus exclusively on our topic today and not rabbit trail ourselves too badly. But there is often more to be considered. So don't go through and say, oh, it's, is this or is this stuff self-dealing? No, we're good, move on. Take a moment and look at what else might be at hand and make sure you've walked through the full analysis.
Really, really, really good point. Thank you, Danika. Appreciate that. And good for the audience, obviously. All right, the next one, a private foundation makes a grant to a public charity to fulfill a pledge by a disqualified person. That would be a self-dealing transaction, and we have that in our panel discussion as well. Private foundation makes a grant to a public charity at the direction of disqualified persons on the board, and their children or family members benefit from the services the charity provides. And it's the same benefits provided to the general public, but it is within the private foundation's exempt purpose. And this goes to what Danika was just describing. There might be conflict of interest issues, and the board member should be recusing themselves, but it's not a self-dealing transaction. So again, not self-dealing, but there could be other issues that you'd want to be aware of and definitely think about before moving forward with that transaction. If a private foundation makes a grant to a public charity, earmarking the funds for the benefit of disqualified persons' children or family members, and it is within the private foundation's exempt purpose, that would be a self-dealing transaction. And that's the earmarking and specifically indicating that it benefits disqualified persons' children or family. Private foundation gives a de minimis gift to a disqualified person. And I know the whole audience is going to argue what is de minimis, or that $25 is de minimis. We do have $25 on our slide. The point is, it's something like, in this example, flowers, a pen, a plaque, a token gift upon retirement. That would not be a self-dealing transaction. Now, on the other side of that, if the private foundation gave a gift of cash or a cash equivalent, a trip, a vacation, tickets to a professional basketball game, soccer game, whatever it might be, that would be a self-dealing transaction. Those are cash payments. They're taxable. They need to be reported as such. And then the last one, private foundation makes a payment for services, sorry about that, to a disqualified person, so a family member, controlled entity, board member, for investment services at or below fair market value. That would not be a self-dealing transaction. And we're going to, oh, I'm sorry, I did not populate the rest of the chart. Thank you, Misty, for letting me know that. Very sorry about that. That we're gonna talk about that on the next slide when we talk about exceptions, and that's why we have an asterisk there, but that would not be a self-dealing transaction. Misty or Danika, before I talk about the exceptions and we go into our panel discussion, any additional things to add related to this slide or any of these examples?
No, we'll get into some interesting nuances in the panel discussion.
Okay, great. All right, I'm gonna make sure I am advancing the slides timely. All right, did want to just quickly touch on some self-dealing exceptions before we get into that panel discussion. So a transaction between a private foundation and a disqualified person, when the disqualified person's status arises only from that transaction, or a transaction with a former disqualified person, would not be self-dealing. The most common example that I've seen in this is an estate. There's some assets that are going to come into a private foundation based on someone's will, and the assets go to the estate, and then the estate contributes, and that makes the estate a disqualified person. But that transaction alone is not self-dealing because the estate was not, any transaction subsequent to that with the estate could be self-dealing, but the sole contribution at that point does not. Providing the following if reasonable and necessary for carrying on the exempt purpose: goods, services, or facilities provided to a foundation manager or volunteer, and compensation for personal professional services. We're going to talk about that one. That'll come up probably a couple of times in our panel discussion, and that's a very common exception that we see. And in fact, when I had that page of the tax return open, if you answer yes, that you entered into one of these transactions that we've talked about that could be self-dealing, there is a follow-up question. I don't like the way it's worded. It's kind of a double negative, but it basically is getting at, if you entered into one of these transactions, was an exception met that would apply? And this is the most common one where you're going to see a yes answer on a private foundation return, and that the exception was met. And we'll talk about how you meet that exception during our real life discussion. Furnishing goods, services, or facilities by a disqualified person to a private foundation at no cost. And then furnishing goods, services, or facilities by a private foundation to a disqualified person if made on a basis no more favorable than are made available to the general public. So admission to a museum is a good example there. All right. We will dive into our panel discussion, which will cover some examples, some tips, some pitfalls. And the best theme is these are real life examples that we've advised on, or in Misty's case, she dealt with in her previous role. All right, I'll go ahead and kick us off and kind of tee up some of these examples for Misty and Danika, and I will chime in as well as we go along. All right, Misty, I know that you wanted to talk about inadvertent disqualified persons and really the need to track investments and flag those ownership percentages. You want to talk about what you've experienced there?
Yeah, and this we had a question about this, about what are the sort of best practices for policies and procedures to track disqualified persons. And the answer is it's pretty robust, and it is very dependent on your foundation and your founders, your substantial contributors, and your board members and foundation managers, and how active they are in either operating businesses or investments generally. And so one best practice to adopt is to at least annually, although annually can be too infrequent if you have very active investors that are part of your disqualified persons list, but at least annually have each of your disqualified persons provide a list of investments. And determine which of them do they own more than 35% of, and are those investments potentially customers or vendors that the private foundation may find itself doing business with in some way. As a real life example, private foundation's founder, unbeknownst to the private foundation, made an investment in what ended up being, through some reorganizations and mergers, a landscaping company. And they owned 40% of that landscaping company. In a sort of seemingly non-consequential conversation, the facilities manager of the private foundation was just sort of talking to the facilities manager of the family office, and they were just sort of talking. They're like, hey, we just started using this landscaping company. They're great. They're fantastic. We love them. You guys should think about changing your landscaping company to them. So private foundation had no idea of the ownership percentage through, and like I said, it was through a structure that made it hard to know. And it came up in a conversation during year end with the tax return preparers talking through and doing that sort of backtracking of, okay, let me see the investments of your disqualified persons. And it came up. And this was like 3 months into the landscaping contract. And so we'll get to the corrections phase of it, but all of that was triggered. And so it crossed a tax year, which meant that it required reporting on both returns and all of the reversals and all of the things. And so keeping a list and maintaining an updated list of those investments of your disqualified persons is really important. And you guys know your boards. Sometimes that's not something they'd like to share, but it really does have to be sort of a requirement for serving on the board. And providing that, because it is easy to trip on the rules, and the net is really broad. It's really wide because you're both looking at entities that they own 35% of. You're looking at entities that own 20 or more percent. If you have corporate disqualified persons or organizational disqualified persons, family members. So when people get married, when people have children, all of those get pulled in. And Danika mentioned multi-generational foundations. And so it's just like a family tree grows over time, your disqualified persons are going to grow over time. So keeping that list in a sort of safe and secure and constantly maintained place within the foundation records is super important.
I would just chime in to remember trusts, family
yes.
trusts. Those tend to be forgotten, I think, in this analysis. So just make sure those are on your awareness.
Yep.
And I was just going to add quickly, we have a lot of private foundations that are heavily invested into alternative investments. So partnership interests, real estate, that come through partnerships. And while most of the time that's generally passive income and it's small, very small interest by the private foundation, that's another area in terms of keeping track of your disqualified person's ownership and investments. Because especially with a family foundation, you see that the family is investing similarly. They've been investing that way, I guess I should say, in the reverse. And then the private foundation is set up and they end up having the private foundation invest similarly. And we've got, I think, a couple things we'll talk about that are in that same theme, but I just wanted to mention that as well. So I agree, having a good understanding of what your disqualified persons are invested in. And I know, sometimes we'll get the comment, well, that seems really bold to ask our board members and officers those questions. But I think for private foundations, it's necessary to have that understanding and those facts. All right. Misty, again, sales, leases, and loans by the private foundation. You want to talk about any real life examples that you've experienced there?
Sure. And this is where, Wendy, your comment that these rules are not intuitive, they are not based in fairness or what is in the best interest of the foundation. They are just strict black and white rules. So any sale, lease, or loan by the private foundation to a disqualified person is self-dealing. Now, Wendy mentioned, and it's true, so there is the flip side. If a disqualified person makes a sale, lease, or loan to the private foundation at no cost or without interest or fees, that's okay. But anything that is from the private foundation to the disqualified person, even if it's at or above fair market value, so would otherwise be considered fair to the foundation or a good deal to the foundation, will violate the rules. And so this can be tripped up, and then this sort of interplayed with there is no de minimis exception. It is a sharp cliff that you fall off of if you trip over. So real life example, private foundation was moving offices. So they were growing, and so they were working out of a small office. They built a nice big building. As part of the nice big building, they bought all new furniture and new desk and new desk chairs. And so they had these pretty fine desk chairs that they had in their old offices, but they didn't, they weren't going to move them over. So the private foundation decided that they were going to sell those desk chairs to their employees at cost, or at whatever the discounted cost to fair market value. Well, the executive director thought, well, I'd love to have a chair like that at my house. So here's my check for $100 for the chair. And that's not okay. The executive director is a disqualified person. Even though that is a fair market value sale, the executive director could not buy the chair from the private foundation. And it's a really hard conversation to have, like that, because that example really illustrates just the harshness of these rules, because you have to have the conversation with your executive director. No, you cannot buy the chair that all the other employees who are not disqualified persons can buy, and just make them aware that is just how the rules work. And so sometimes it does necessitate hard discussions and conversations. The key to that is training. Bring in people, bring in Wendy or Danika or me, your lawyers, your accounting firms. Do sessions on what self-dealing is to your board members, to your executive director, to your finance and legal teams, so that they understand, because the rules are not intuitive. You can't just sort of think about, what is fair or what's a good deal to the foundation. And the consequences are serious and hard to get out of. So, so the more you can educate your team, the better.
That's great. Thank you. All right. This next one is going to get us into some talking about an exception as well. But Misty, I hate to keep putting you on the spot, but you want to start us off just talking about reasonable compensation?
Yeah. So I'm going to use this one as an opportunity to pick up a couple of the questions we received in the chat. So the important thing to remember about reasonable compensation is the default rule is that compensation to disqualified persons is self-dealing. So that's the default rule. The exception is for reasonable compensation paid for personal services that are necessary for the advancement of the foundation's exempt purposes. So sort of put that exception a little bit to the side a bit. So compensation to disqualified persons is self-dealing, including reimbursement of expenses, unless it falls under the reasonable comp exception. So to that point, I wanted to address two of the questions that came up in the chat. One was a question about if you have a disqualified person who has a corporate card of the foundation and they accidentally charge a personal expense on that card. In my experience, this happens all the time. And in fact, like I wish people would not, or I wish foundations actually would not use corporate cards or give them to disqualified persons, because it's really hard to monitor this. Technically, under the self-dealing rules, an extension of credit to a disqualified person is a self-dealing act. So it's really hard to prevent accidental slip-ups. From a best practice perspective, I would highly recommend that all of your disqualified persons who either submit expense reports, which is the better way to do it, because that way it can get caught before it's reimbursed, or corporate card charges, which is the harder thing to do. Have those be reviewed by someone on your finance team. Have there be a second layer of review before the expense report gets paid, before the payment of the corporate card, so that if something is caught and it's a personal expense, the best case scenario is that you can reverse that with respect to the disqualified person prior to the paying of the credit card. It's not perfect, and technically once you charge it on the card, it qualifies. If you are able to reverse it before the credit card is paid, you could make an argument that that is not an extension of credit and that it's sort of fleshed out. But just be really careful with corporate cards and expense reimbursements, and definitely have all of your disqualified persons submit those to someone in your legal or finance team for review before payment. That can get tricky because a lot of disqualified persons don't want your accountant to be looking at their stuff before it gets reviewed, but again, it's necessary. And again, sort of really think about the need for a corporate card, because those are much harder to reverse. If it's an expense reimbursement and it gets reviewed, you just deny the expense and have them pay for that personally. Another question that came up in the chat was reimbursing spouses of disqualified persons for travel. That's a tricky one, because technically if there is not a need for the spouse to be there, there's not a reasonable basis on which the private foundation should reimburse that cost. Sometimes you can have sort of like dinners where you're bringing spouses in, and if all you're doing is adding additional plates to the dinner, then that's and you have you can make an argument that sort of having spouses there helps to like build camaraderie among the board members or things like that. That can be helpful. But spouse travel, even outside of the private foundation world, is sort of an area of touchiness with the IRS. So just think about the reason for that. And I don't know, Wendy or Danika, if you guys have other thoughts on spousal travel that you've encountered. Because I know it comes up a lot.
I would maybe chime in on that. I do approach these sorts of things incredibly conservatively, and I have yet to see, and reasonable advisors probably differ here, but I have yet to see a situation where spousal dinner or spousal travel, I felt solid on it. It probably exists out there somewhere, but I don't think in my mind you necessarily get there just by saying, oh, everyone's bringing their spouses, because of course they do. I think that in my mind, the threshold has to be a little higher than that. I also think from a best practice perspective that when you're dealing with any spousal type of issue, whether it be reimbursement, travel, dinner, event tickets, all the things, it gets to be a slippery slope very, very fast. And so I tend to prefer and advise clients to just draw a hard and bright line and not to go there to avoid that inadvertent misstep.
I agree. And I would apply the same conservative approach to credit cards. That's why, from my perspective, the best practice is to either not give your disqualified persons credit cards, or like have like an administrative assistant that knows that they can only that credit card can only be used for that person's travel, foundation travel, or clearly foundation related items, because foundations come up with sort of practical ways to try to reverse an accidental charge, but once it hits that card, you can't undo it, and so you're rolling the dice to some extent, regardless of how you do it, which is why the expense reimbursement path is the much preferred path, because then you can catch it before the disqualified person is reimbursed.
Well, and I was going to chime in with the answer to what I think was maybe two different questions, and recognizing we probably need to pick up our speed here if we have any hope of covering any bit of our outline. But there were at least two questions, I think, around investment management. And that, yes, generally speaking, when you're in this realm of personal services, which really actually means professional services, so poorly named exception in my opinion, but investment management is one of the more common arenas that qualifies for this exception. So, that will come up, and I'll kind of address it when we get into some of those joint investments even. Very, very common for the investment manager to be a disqualified person or a family member, the kid, the grandkid, you have it. So long as you've gone through an appropriate process, that is absolutely something that can qualify for this compensation exception from self-dealing and be acceptable.
Yeah, exactly.
And I was just going to add.
Go ahead.
Oh, sorry, Misty, go ahead.
Okay. No, so I was just going to move into, so the reimbursement side is a sort of a specific area of under the compensation exception. But generally speaking, the reasonable compensation exception that most foundations rely upon to pay, for example, the executive director a salary, which makes sense, is the what's known as the personal services exception, which, to Danika's point, personal is really more professional. So the two specific examples in the regs that are that qualify as personal services are legal services and investment services. So those are the areas that are sort of specifically blessed by the regs. Rulings have expanded that to generally mean financial, administrative, managerial type services. What's not included is operational. So if you are, providing custodial services to the foundation, that's not covered by the reasonable. Not that your disqualified person would normally provide those services, but the example in the regs is you have a disqualified person who makes microscopes, and the foundation pays the disqualified person to make them microscopes. They must be some sort of scientific or medical research foundation. That does not count. That does not qualify for the personal services exception to the rule. So it has to be personal/professional services. The compensation has to be reasonable, and which means the foundation has to demonstrate that in some manner. Most foundations utilize market comps for their disqualified person compensation. And it has to be vetted correctly. Like you can't, you have to look at not only the role, but how much of their time are they spending? So if they're only spending half of their time, you should compare it to the market at half the rate, right? For a half-time, for a part-time person. And what they're trying to, protect against is, and especially with family foundations, with multi-generational, it's sort of easy or tempting for the parent, the patriarchs of the foundation to say, okay, this foundation is going to employ my children and their children and sort of so on. But if those children and grandchildren aren't actually performing services, they're just taking a paycheck, then that's not going to qualify for the exception, because the services have to be necessary for the furtherance of that foundation's exempt purposes. And so looking at what are they doing and what is sort of market rate for what they're doing, and do those align? Wendy, I'm sorry, I think I cut you off.
No, I was actually going to cover exactly what you just covered. So it's like you read my mind. So thank you. I did just want to add one additional thing, and it goes back to the credit cards. I don't know how either of you feel about this, but we have had a few situations where we've just recommended that there be, it's not a petty cash account, but each disqualified person that has a credit card has an amount that's on the books of the foundation. So they've given cash to put into this account just in case there's an accidental personal expense. It's already been given by the disqualified person.
If they can get their arms around tracking it and staying on top of it, that's not a bad backstop. I've not actually seen that before, but that's not a bad backstop. I think my concern would be, and I presume these were not the clients who had to worry about getting their arms around it, but right. Not everyone can quite handle that level, right? And so I think a lot of our clients sometimes really need that bright line and find it to be just what keeps them on the straight and narrow.
Yeah, no, and I agree. I just thank you for your comments on that. And we should probably move on because I know we're at halfway point, a little over it. And I know we've got a lot of questions in the chat as well that we haven't covered yet. And just for everyone's knowledge, if we don't get to your questions during the session, we do follow up on all the questions after our conference. So we do have folks that are keeping track of all these questions in the chat. All right. So what about situations where there's a family office, business issues, so sharing space, personnel expenses? We've touched a little bit on some of these things, but not necessarily in the family office context. Misty, you want to kind of kick us off and talk about that and what your experience has been there?
Yeah, and you're right. I mean, these issues apply whether you have a family office or not. It's just that we in our experience, we see that when there is a family office, it is really easy for these issues to come up. And the most common issues are with respect to shared office space, shared personnel, shared office equipment, so printers and copiers and paper clips and all of those things. And then sort of an additional nuance like group insurance, like if you have a group insurance plan that you're able to cover under a group policy, how does that work? So I will just sort of mention, so the absolute best practice, safest structure in any of these types of areas is for the foundation and the family office to have completely separate either space, contracts, employees. So even if you're sharing an employee, have the foundation employ them for 20 hours a week, and the family office can employ them separately for 20 hours a week. And that employee, tracks their time very carefully and says, okay, I'm working these 20 hours for the foundation for this salary and these 20 hours for the family office at that salary, and it's separate and they're separately paid. Same thing on a lease. Like if you have a shared space, talk to the landlord, see if you can divide the lease, have the private foundation pay directly to the landlord under a lease for their, square footage, and the family office separately. Contracts, if there's vendors that are, sort of servicing both entities, try to have separate contracts. That is not always possible or really viable for either entity. So the second best scenario is to have, if you can't separate the lease, if you can't separate the contract, have separate payments. So have the foundation and there is some rulings in the group insurance context where this was blessed. So if you have sort of a group insurance plan, if the foundation is paying directly to the insurance broker and the family office is paying directly to the insurance broker, then that was deemed to not be self-dealing because each person was paying directly for their own, or each entity was paying directly for their own piece of the plan. And the underlying rule around this is documentation. Like however you structure it, just be meticulous about this is what the foundation uses and they're paying directly for that. This is what the family office uses and they're paying directly for that. We do get a lot of clients that come to us after the fact where there's a reimbursement arrangement between them. That's not great. That is always that is not a good thing to plan for. And so, like I said, we get it on a regular basis for foundations that have been doing that for a long time. They come to us and say, okay, this is what we're doing. To the extent that you can, separate it. If you can't, especially, and typically it's on a services agreement, the documentation has to be very, very carefully maintained. This is how many hours this person is working, and they're working for the benefit of the foundation. And be clear in the documentation that the payments that the foundation is making meets the definition of the exception. It is for personal services, it's reasonable, and it's for services that are necessary to the private foundation's exempt purposes. And document it that way so that it's clear that even though the payment is to a family office or a related entity, it is for personal services, and that it can utilize the personal services exception. The documentation is key.
And I agree, Misty. Most of the situations I see, I think the reality from an administrative burden perspective, there's some sort of shared services agreement, but the employees, the agreements remain with the family office. And I completely agree. Just wherever you can separate the payments and the documentation is just so key in those situations. All right, Danika, I think you're up. We're going to give Misty a little bit of a break here. So why don't you talk about co-investing? You've alluded to this a little bit already, but with disqualified persons and other types of securities transactions. In particular,
so
no, go ahead.
I'm going to try to talk fast and catch us up a little bit, maybe. There's one, I think it's important to be aware, like with all of this, this area of investing together, framed loosely, is something IRS has paid attention to for years. There is a ton of guidance and a complete lack of clarity. But hopefully I can draw some lines and parameters for y'all today. The IRS has talked for a long time about giving us guidance. It's, I think, been on the list since pretty much I began practicing. So maybe someday, but in the meantime, we've got kind of two different scenarios or contexts to consider. We've got side-by-side investing and joint and co-investing. Wendy kind of alluded to some of those side-by-side situations. We see typically the concept of where the foundation and the disqualified person are coming in independently to invest in something. A lot of the guidance kind of centers around real estate, real property types of investments, things that can be easily partitioned, right? So you have that clear separation. And then we look also at, and what we advise more commonly on, is what we call joint or co-investment, where foundation, disqualified persons, and probably often others as well, are coming in together to invest in something else. That is more the fact scenario that you see coming up in the family office situation, where they're setting up an investment fund or a fund of funds, or otherwise pooling the foundation funds with disqualified person funds in some way inside of a vehicle. As I mentioned, this is where you sometimes see a whole lot of issues coming up, because we've got self-dealing issues, we've got conflicts issues, we've got compensation issues, all kinds of fun stuff. But I'll give you kind of some framework to consider from a practical perspective as to how to work within this fact scenario. The big takeaway here is trying to ensure that there is either no benefit, direct or otherwise, to the disqualified person by virtue of this arrangement or by virtue of anything that the foundation does with respect to the arrangement. So first, that comes up in the context of minimum investment requirement. Never should the foundation do something that allows a DP to invest when they couldn't have done it otherwise. So we need to make sure that the disqualified persons can meet whatever that minimum is, or maybe it's the disqualified persons and the other people involved in this investment. They've got to kind of hit whatever the threshold is first, and then the foundation can be over and above, right, to ensure that they're not in any way enabling the disqualified person and therefore giving them a benefit. You see this in the context also of withdrawal or exit provisions, when you're talking about, again, the investment fund type of concept. We want to give the foundation as favorable and as flexible provisions as possible to get out or withdraw, maybe even more favorable than those that are given to others. I will caution you there, though, that depending on what type of context we're looking at, treating investors just differently can both raise like securities issues in terms of an offering. It can also bring up liability issues from an investment fund perspective. So you've got to make sure you're checking that box as well. But oftentimes those conversations result in a whole lot of negotiation between us as exempt organization, foundation counsel, and the investment fund legal specialist. Say, okay, well, how can we splice and dice this to do something that's acceptable, but sets it forth in a way that will work. Third, we want to look at both allocation of costs and expenses and kind of return and savings to make sure, again, that kind of all of the benefit, whether it be in terms of decreased cost because the foundation has joined or increased returns because the foundation has joined, we want to make sure that none of that is attributed in any way to the disqualified person. So the foundation should get as much of the benefit there as possible and not the DP. Again, got to pay attention though to that issue around treating investors differently from a securities perspective. One that I've seen come up quite often, because oftentimes the situation that arises is private foundation, son, kid, granddaughter has just graduated from MBA and wants to set up the new fund of funds. And we're looking at that. So one of the things that comes up in that context is, okay, we can get there and we can do that if we jump through all of these hoops and we address the compensation issue. But let's also make sure that we're not advertising or marketing the participation of this giant foundation and all of its assets in terms of attracting new third-party investors to that fund. Because there would be a benefit there to, son or granddaughter in my example, who's running that fund. Be aware of that. I think it helps also if this investment by the private foundation is a relatively insubstantial portion of the PF assets. Sometimes that doesn't work, but an extra good factor. And then maybe two last points on this. One, we always want to make sure that the private foundation in any investment context like this has, again, as much flexibility to get out if we ever see a jeopardy for tax exempt status, any risk there, or an out if there ever becomes an excise tax issue. So if we've done everything we can and yet the IRS took a different position, we want that foundation to be able to get out to enable the potential possibility of correction. With that, hopefully that was fast enough. That's all I've got to say about those.
That was great. Thank you, Danika. I think our next topic we wanted to talk about was some real life, and is satisfaction by a private foundation of a charitable pledge. And I know we answered a question in the chat as well in terms of what constitutes a pledge. But Danika, why don't you speak to this first, and I have just a little bit of context to add as well.
Yeah, I'll go quick because the rule is really simple. If it's a legally binding pledge based on state law, you can't do it. I mean, that's just as simple as I think what it is. I don't think we answered that question yet, but I knew I would, so I proactively checked it off. I will give one maybe caveat here, which is don't get confused with the rules around donor advised funds. I'm not going to talk about them, but there may or may not be more flexibility there. It's not the same for private foundations. And I think that's all I have to say. Wendy, do you want to talk about your real life example?
Yes, I just wanted to quickly touch on a couple examples. Something that that's been brought to my attention more recently with some corporate foundations. So and we had this question in the chat and I just answered it, but it's a foundation established by a corporation versus a family. Oftentimes corporate foundations are private foundations just based on the fact that the corporation is the primary funder. They're not public charities. They could be, but in our scenario, as we talk about corporate foundations, in this context, they're private foundations. So giving platforms, I've been seeing this come up where the giving platform the contract is entered into with the corporation, but the foundation is making the payment for the invoices because the foundation is the one using the giving platform. And obviously you want to correct that and get the agreement in place with the foundation, but I kind of view that as similar to a private foundation satisfying a pledge. It's not a charitable pledge. It's not in that same context, but I wanted to share that example. And then the other one that I was thinking of is I see in more the family foundation space. And again, I use that term. Family foundations are often most likely private foundations just based on their funding. But they, think about individuals, and I do this myself. You have tickets, your alma mater, you have tickets to the football games every year, you contribute and give to the university. And with that donation, you may get better opportunity for seats or opportunity earlier for seats. I have sometimes seen, because there wasn't good education when the person set up the private foundation perhaps, or whatever the situation, but they've pledged a certain amount to the university for their season tickets that year, for example. They just have the foundation start making those contributions. So sometimes these can be simple, but definitely trip up in the self-dealing area and cause a self-dealing transaction.
That was a great segue into our next topic. Way to do that very seamlessly, Wendy.
Great. Why don't you talk about galas and tickets? And I know we've got to move on so we get to correction and our last polling questions, but I know that this is an important one, and I know it comes up a lot. So let's just
I'll be fast. And the good news is this discussion is not limited to galas and tickets. Same issues come up in the type of scenario that Wendy just mentioned. Anytime where you have the foundation either purchasing something where there's some benefit that could come back to be used by a DP, whether that be, art or tickets or, the ability to buy the good tickets at the football game, membership, parking, you name it, where the foundation is granting something that comes with those benefits, it can also arise. And again, you can see the theme in everything we're talking about. We're over-analyzing to ensure no benefit to the disqualified person. So this can apply, beyond that gala and ticket scenario. So first, let me tell you what is okay, because this is kind of our starting place and gives you the most flexibility, I think, when you're looking at these questions. Officers, directors, employees of a foundation acting in their official capacity and attending or using some benefit in furtherance of the purposes, great, that's okay. No problem whatsoever. It's okay for the foundation to pay for, the cost of the rubber chicken dinner, the value of the rubber chicken dinner, and for that extra charitable component that comes along with it that gets you in the door. Totally fine. Couple nuances. Not totally fine for spouses, kids, guests of disqualified persons, because they're not acting, for anything to benefit the foundation in attending. Also, if we're going to rely on this and say, okay, well, yeah, director so-and-so was attending this fabulous gala that the table cost, $50K. They were attending to, monitor the use of the foundation's grants. That's doable and we can get there, but we need to make sure, again, that the reality aligns with that. So, if we're doing that, then they need to actually be doing such things. There needs to be a reason for them to be there in that way. The foundation probably should have made a grant to that organization sometime in the recent vicinity. So a lot of little pieces where I think foundations look at it and say, oh yeah, we're going for this reason, we're fine. But you got to make sure that the facts align such that this is justified as necessary for something that the foundation is doing. I want to talk briefly. Oh, I did see a question about this. Someone asked, what if a disqualified person is invited by a friend to a gala? And that's, I think, a totally different scenario. Presumably that friend is not using, not buying the ticket with this private foundation's fund, the one we're talking about with respect to the disqualified person. So that's fine. That's really a non-issue. The issue we're focused on is private foundation and its own disqualified persons and money from the foundation in some way benefiting. So once you get outside of that analysis, it actually simplifies things quite a lot. What we see in this space, and man, I see this a lot with other advisors taking a lighter version than we can get comfortable with. There's this concept of bifurcation and saying, okay, well, if the ticket cost $100 to get in the door, the chicken dinner was worth $20, the charitable portion was $80, and the non-charitable portion was $20. So we'll just have the DP reimburse the foundation for the $20, and then nobody got any benefit. We're good to go. That does not work. Do not do that, please. There's actual very clear guidance that does not work. Sometimes we can get a little bit creative and find some workarounds there sometimes, but it's something to be very aware of. And I think, again, I've alluded before to kind of that sliding slope issue. The number of times where I have seen foundations waver from kind of that really clear bright line rule and end up in a situation because of this is high. So I would strongly encourage sometimes taking a more conservative stance than is actually required. We like our private foundations to either specifically prohibit the use of benefits by any disqualified person, if they're going to allow it, we like them to at least clarify who, what, when, and why. And maybe, get real specific about the facts that you can rely on in that situation. We love when our private foundations will structure their grant programs to either avoid or refuse the receipt of tickets or benefits or things that come back with it, because then we never have to deal with this. We definitely have foundations that also have kind of a proactive community-based approach where they identify local charities that might be able to use those tickets and partner in that way. So all of that is probably enough to say about that topic.
That was great. Thank you, Danika. And we had a few more areas that we wanted to touch on. There's more issues, but we want to make sure we get to correction and speak to that. And we want to make sure we get to the rest of our polling questions so that you all get your CPE credit. So I think we'll shift. And then if we have time, we can come back. And I know we have a number of questions in the chat. We're tracking those as well, trying to answer them as we go along. But like I said, we will answer those after the session, after the conference as well, if we don't get to them. All right. Correcting a self-dealing transaction, correcting a prohibited act. So not only you've identified a self-dealing transaction, it does have to be reported. So it's not just the question on the 990PF, and I'll go through the form here in just a minute, but you have to report it. There's an excise tax, and it has to be corrected. I've had private foundations say to me, well, we're okay with paying the tax. We won't do this again, okay? And I'm like, well, no, you actually have to correct it. And it actually asks you when you report it, if it's been corrected. And you have to describe in detail how it was corrected. So it's not just okay to pay the tax. You actually do have to have the transaction corrected. So the correction steps, depending on the type of self-dealing transaction, could be a little bit tricky. It might take, it's going to take some probably difficult conversations, some hard conversations, because it may require asking for some money back, whether that's from an employee that was paid compensation that wasn't reasonable, they charged something on the card, those types of things. So if the transaction cannot be fully undone and rescinded, the private foundation must be placed in a financial position not worse than what it was before the transaction. So think about, a repayment. The approach that we have taken with our clients is, the interest needs to be provided back to the foundation to make them whole. For example, to the self-dealing and report the self-dealing on the 990PF, but also on a 4720. So show so that you can see the form. Now keep in mind, the 4720 is a form that the foundation has to file alongside their 990PF, but the foundation, just a reminder, the foundation is not paying the tax. So that could be the family office. It could be a board member. It could be a corporation that entered into a self-dealing transaction. That goes with the 990PF by the private foundation is informational, and it's going to indicate who the self-dealer was, but it's not going to calculate tax on there, and there's no monetary amount that's going to be filed. This is just an example of a statement that could be presented. I also wanted to just point out that a self-dealing transaction occurs each year that it's not corrected. So the same transaction could repeat itself and be subject to the tax for multiple years until it is corrected. With that, before we get into a little more discussion on this, I think we have a polling question. Sorry, my delaying us a little bit. All right. So who pays the tax on a self-dealing transaction? Private foundation, disqualified person, a disqualification, or not sure. And I apologize because I did not mention the foundation manager If there's allowed the private foundation to enter into a transaction and they knew it was self-dealing, they could be subject to a tax as well. So I am sorry that I did not mention that sooner.
All right, Wendy is going to check her headset. I know she was glitching out a little bit there. But while you're responding, I do just want to remind you that for this session, you do need to respond to 5 of the 6 polling questions to receive CPE for this particular session. All right, we'll give this a few more seconds and then we'll close it out. And here are the results.
People are paying attention.
Wendy, I think you're on mute.
Well, and I think it looks like Wendy's having some tech issues. Gotta love those. Can you hear me now? Can you hear me now? So are we able to keep going through the polls while she sorts that out? And maybe maybe I take us just a tiny bit out of order. Wendy, chime in if you get it sorted. No, not yet. So maybe if I can shift gears while you sort that, rather than taking your slide, and talk a little bit about some strategy issues that come in with correction, and then you can come back behind and focus on the actual taxes. Trying to roll with it here. So a couple things that I thought worth mention when we have the foundations that come to us and end up with a correction scenario that needs to be addressed. One, which you may have heard us starting to allude to just a bit in terms of how we respond to clients with these issues. I do want to highlight for the group that there is a little bit of a different lens to view if you are planning and advising on something that might happen in the future. Typically, we tend to take a very conservative stance with respect to those issues versus looking at whether something did occur and what reporting needs to happen. So oftentimes in the latter situation, we might feel comfortable taking just a little bit more of an aggressive approach and saying, gosh, well, we wouldn't have advised you to take this particular transaction in exactly this way. Maybe we can get comfortable with an argument as to why there wasn't self-dealing. So, again, that's super facts specific. Sometimes there's no option to do that. Sometimes it's clear as day that there was self-dealing and you simply are in the reporting situation. But I would encourage advisors to be aware of those two different perspectives depending on what you're advising on. Okay. The other thing that I wanted to mention here in terms of kind of strategy, Wendy mentioned early on in the beginning of the presentation, those trigger questions and the ones that we often see might be answered yes, but then you're relying on an exception to self-dealing. Those become really relevant in this concept of reporting and correction, because oftentimes we might be looking at, okay, well, what was disclosed on a return, and that may well impact whether or not we feel as though a statute of limitation is still open in terms of going back and paying tax or amending returns and addressing a correction type of issue. I think that statute of limitations issue is probably the biggest and most impactful one that I see in terms of how correction is done and how reporting follows behind it. So for those who aren't aware, generally speaking, that statute of limitations will begin to run on the date that either a return is due or the date that the return is actually filed. If we've got a situation that's fraudulent, false, tax evasion, then we don't have a statute. But so long as we don't have that, and I'm lucky to say that has not been a situation I've come onto yet with clients, then we're either looking at a 3-year period of limitation or 6-year. And the difference between those two ultimately comes down to the level of disclosure that was on the return. So where we have a situation where maybe self-dealing has occurred for 20 years and no one realized it up until now, but it was in fact disclosed in some way on the return that we can get comfortable with, oftentimes we might only be looking at a correction and reporting scenario for really a 3.5 to 4 year time period, looking at that open statute. So that's something really important to pay attention to. The other maybe 2 factors I'll mention there really briefly, and then I'll tee it back to Wendy to continue her piece. One is there's also a question of how far back and whether, if at all, you need to amend the 990 PFs for any time period where any of this happened. We've seen it fall out both ways. Often with self-dealing, we do end up going back and amending because there is, a little bit more of a material impact on the return, but there's a decision to be made there. And then lastly, I think it's important to remember the timing of corrections and how that interplays with current returns that are being filed. So there's that question kind of buried in within those trigger questions that says, hey, have you done something that is listed above and you haven't corrected it yet? That question tends to inform many of our decisions as to when, how, and kind of what can happen in this full context of reporting and correction. Okay, no Misty, okay. Oh yeah, no Wendy, sorry. Okay, so maybe Misty, to keep me from talking, do you want to talk a little bit about the penalties, or do you want me to jump into this and cover?
Sure, no, I can pick it up.
Awesome.
Yeah, so Wendy did tee this up, and it was actually the subject of the last polling question. So the private foundation does not pay the excise taxes, and cannot and should not pay the excise taxes. The excise taxes are imposed, generally speaking, on the disqualified person, and it's an initial excise tax of 10% of the amount involved. So we could do a whole nother session on determining the amount involved. But for this session, we'll leave it at that. With respect to each act of self-dealing, and then in addition to that, there's an additional 200%. And if that sounds punitive, it is. It's supposed to be. 200% tax if the transaction is not corrected within the proper time. And that's typically after it has been discovered or a specific, or you've gotten notice for that. As we've mentioned before, there is no de minimis or reasonable cause exceptions. So you just have to pay the tax. So the disqualified person is the initial payer of the excise tax. And then a foundation manager who knowingly participates in an act of self-dealing. So here's where knowingly comes into play. So with respect to the disqualified person and the determination of an act of self-dealing, there is no reasonable cause or de minimis exception. But for purposes of the foundation manager liability, there is a knowing element. And so if the foundation manager knowingly participates in the act, so that it's it's not that it's not willful or due to reasonable cause, that foundation manager also has an excise tax liability equal to 5%, an additional 50% if there's refusal to timely correction. So that's was the answer to the last polling question, which is it is not the private foundation's tax. It is the disqualified person's tax and possibly the foundation manager's tax. And the private foundation should not pay that tax because that would be an additional act of self-dealing if they paid the tax that's owed by the disqualified person. Wendy, are you able to advance the slide? I'm not sure where you are in your tech.
I can do it.
Can you hear me okay?
Perfect. Okay, and then we can skip that. This is a great, so I do recommend that you guys pull that off. It is a great resource, but it just repeats what we just said, so we won't spend time here. And then, Wendy, do you want to take it over?
Can you hear me okay?
Yes.
Mm-hmm.
Great. Thank you very much for covering for me there. All right. So some methods to lower your risk of self-dealing. We talked about this already, but education. I just cannot stress enough, and Danika did as well, how valuable it is to provide education to your board, even your staff, your key employees, because everyone is probably touching some of these transactions that we've talked about, or things that can come up, even in the grant making space, where you want to have an understanding of self-dealing. Identify and track your disqualified persons throughout the life of the foundation, adopt a conflict of interest policy, and make sure that that's robust enough that it's including investments, that you're revisiting that at least annually. Implement and follow a compensation setting process so that you're only paying reasonable compensation, in particular to disqualified persons, for personal services. Maintain accountability by implementing procedures for reimbursement to and credit card transactions for foundation-related expenses. And adopt a policy on grants that result in a benefit from the grantee, such as the tickets and events that we've talked about, and track who uses those benefits. All right, we've got 2 more polling questions. What is the state of policies and procedures, that's P&Ps, in your organization? We have comprehensive and useful policies and procedures. We have some useful policies and procedures, but need more. Our policies and procedures aren't comprehensive or are outdated. I should have put a D on here. We are in the process, or we haven't yet developed policies and procedures, because that could be an option as well. All right, how are we doing with the results, Amy?
We'll give it a few more seconds here. Make sure to hit that submit button. All right, here are the results.
All right, so about 50%, we have some useful policies and procedures, but need more. And about 37%, we have comprehensive. So that's great. That's really good. Just about 12% aren't comprehensive or are outdated. All right, we have another polling question. How many 4720s will be filed for a self-dealing transaction, and by whom? And I can see now this needs a little more clarification. So if you have if your foundation has a self-dealing transaction that was entered into, how many self-dealing transactions will need to be filed for and by whom? And again, I probably should have given more facts. Now that I see it on the screen and I'm reading it, I can tell that there could be multiple answers here, but
where you were going with that though, Wendy.
1 4720 and by the foundation, or 2 4720s by the foundation and the self-dealer, 1 4720 by the self-dealer, or I'm not sure. And I say that it could be a little bit misleading because there could be situations where there could be 2 self-dealers in the same transaction. Don't see it very often, but it's possible. So a little bit of background facts probably would have been helpful. But appreciate your patience with me. All right, we've got some results. So 42% said by the foundation and self-dealer, and that is the correct answer in the fact pattern I had in my head. And 26% by the foundation. So just remember, foundation absolutely has to file one, but the self-dealer also would have to file one based on their tax year, and they're the ones submitting the tax. All right, with that, I think we have concluded our presentation. Any final remarks, Misty or Danika?
Only that I took a stab at answering some questions, so hopefully we got a little bit more content out there. Forgive any typos as I'm multitasking, but appreciate the opportunity, and hopefully we answered more questions than we raised today.
All right, I'll turn it back over to Amy to close us out.
All right. Well, thank you all for a great discussion. That was a lot of valuable information packed into this session, so we really appreciate that. And to our audience, we are going to take a 10-minute break and then regroup for our next session, which is Leadership and Workforce Isolation and Burnout. So please keep your webcast console open and join us back here at 10:45. Thank you.
Pacific time. Thank you.
Amy, are you teeing us back up or do we just go?
Wendy was going to pop back on here.
Okay.
And
Perfect.
get us going. Yep.
Awesome. No rush.
All right. Well, I hope everyone had a nice quick break. We're going to go ahead and get started again. I hope everyone enjoyed that first session and is feeling refreshed. In the interest of time, we're going to go ahead and move to our second session on today's agenda, leadership and workforce isolation and burnout. And I will now turn it over to Brett Addis, Moss Adams Director, to get this session going.
Thank you, Wendy. And great job on your last session. Really excited to be at the Private Foundation virtual conference. Had an opportunity to present last year. I have two amazing guests, which I'm going to introduce just momentarily. I'm going to make the stigma just keep festering for them. I'm just kidding with you guys. But really excited. This is a topic that is near and dear to my heart and probably many of you as well. As we've gone through a lot of the changes over the past few years with COVID and all of these changes leadership and workforce isolation and burnout are and will continue to be a bit of an issue for many organizations. So just to set the structure for the conversation quickly, and then I'm going to get in and introduce the team. I'm going to set the stage a little bit after the introduction by covering the abstract. We're going to go through some of the learning objectives. I'm going to talk a few minutes about some of the leading trends that we're seeing in this area. And then this is where my special guests, Robyn and Chaney, get to come in. And we're going to do a bit of a panel to really learn how the Kalamazoo Community Foundation has been addressing this issue, some of the practices that they have been putting in place, and really embracing this topic to really regenerate and re-energize, I shouldn't say regenerate, re-energize their workforce. So by quick introduction, Wendy mentioned my name. I'm Brett Addis. I lead our human capital advisory practice at Moss Adams. And then joining me, and Robyn and Chaney, I don't know if you want to introduce yourselves quickly. That would be fantastic. But Robyn, quick intro from you.
Sure. Good morning, everyone. My name is Robyn Bennett. I'm the Director of Human Resources for Kalamazoo Community Foundation, located in Kalamazoo, Michigan.
And Chaney?
Hello, good morning. Chaney Bear. I'm the Human Resources Manager, and I'm also at the Kalamazoo Community Foundation, and typically Robyn is right there sitting by me, but we have two separate rooms today, so thanks for having us.
Oh, absolutely. We're really excited. And so we're going to dive into this really quickly. I want to spend just a minute covering the abstract, and like I said, we'll go through some of the objectives and some of the initial key trends. But, as I was kicking the session off, I said, in today's fast-paced and highly demanding work environment, leaders in our workforce often face unique challenges that can lead to feelings of isolation and burnout. So this session is really aimed to explore the underlying causes of leadership and workforce isolation and burnout and the impact on personal well-being and organizational health, practical strategies for prevention and recovery. So some of the quick learning objectives and agendas, like I mentioned, we're going to understand the causes and symptoms of isolation and burnout. We're going to describe the impact of personal and organizational health, develop strategies for prevention and recovery to enhance leadership resilience and well-being. And then lastly, we're going to discuss ways to create an organizational culture that recognizes and addresses the challenges of leadership, isolation, and burnout. So as I was preparing for this session, I was trying to come up with a really good definition of what leadership and workforce burnout and isolation. I'm not a big slide reader, but I do want to read it and then unpack it just a little bit, because I think there's a couple really interesting points in here. But basically what the definition says, the leadership and workforce burnout and isolation refers to a couple things: chronic physical, emotional, and mental exhaustion, experienced by prolonged stress, overwhelming workloads, or insufficient support, resulting in reduced engagement, morale, and productivity. So before I start, I'm going to ask for a show of hands. How many of you are I'm just kidding. I'm not going to ask that question. But I think what's really interesting here is that when we look at these definitions, or look at this definition, and we start breaking these things out, there's definitely areas of this that, we automatically jump to in terms of, this is what my life is like at work, right? I'm overworked, I'm overwhelmed, I may or may not be getting the right level of support, whether that's from the organization leaders, HR, having the right programs and policies to support my needs. But that is really only one element of isolation and burnout. The other piece that I think is becoming more and more common, especially over the last 3 or 4 years post-COVID, and I would even attribute some of this to remote and hybrid working, is really the stress and isolation of those individuals outside of work, right? And I think we often forget about a lot of those stress and burdens that people are dealing with on a day-to-day basis just at home. And so the question really, as we look at some of these things, is, as employers and organizations, we often focus on what can we do to make our employees more efficient, more effective, more highly engaged, more blah, blah, blah. But the reality is that I think this is really a big opportunity for us as organizations, especially as HR, to really start thinking broader about the entire workforce needs. There is a result to saying, listen, we can only control what we can control, and that's what happens when people are within our bubble of work. But the reality is there's a lot of programs and activities and things like that we can also help address when people are outside of work. And so as we go through this, and I think you're going to hear a lot of this from Robyn and Chaney, is really about not only what they're doing at Kalamazoo to help support and get better engaged and productive people, but really how their programs stretch way beyond that. The other piece I want to highlight here is that this doesn't say employee burnout and isolation. This really talks about leadership and the entire workforce. So we don't want to separate those, right? We are seeing a major trend right now where there's an increased level of stress and burden on leadership, who are also now becoming less efficient and effective. But also when we think about the term workforce, we also think about our permanent staff. What about our contractors? What about our independent consultants? What about consultants that we hire? So the workforce is much broader today than it's ever been before. And again, so as we start thinking about the concepts in here, I want you to broaden your horizons a little bit to start thinking about your organization holistically and how some of these definitions and pieces are impacting everybody. So as I jump into this, I wanted to cover a couple interesting statistics. And the first is that, and I'm not going to go through the sources, but according to 2023, burnout levels have risen to 38.1%. Now, if you think about that in prior years, it's been probably in the areas of 2015, and it has gradually increased over time. The other thing that we have seen increase over time, not only burnout, but is a level of disengagement. Some of this, the research in 2023, 2024 are talking about the highest levels of disengagement that we have ever seen across both leaders and the overall workforce. So these things are going hand in hand between burnout and disengagement. You'll see that the next statistic I find is very interesting, where 96% of CEOs believe that they're doing enough for their employees' well-being. However, only 69% of employees agree with that. So there's a pretty big disconnect here between what the organizational leaders are thinking that they're doing versus what they're actually doing. Now, I want to caveat this. This doesn't mean that the organizations aren't thinking about the overall employee, aren't taking the right approaches to do these things. The question is, are the approaches the right approaches for that workforce? So I definitely think effort here that's being put into this. The question is are we spending our time and our energy and our money towards those right programs to really help our employees from their well-being perspective? The other piece of this is we look at some other statistics in 2023 from the Workplace Wellbeing Report. 43% of senior leaders reported experiencing burnout themselves, right? So this kind of gets back to my last slide, which is this isn't only our traditional level of workforce. We've seen, especially coming out of COVID, where we had to do some organizations had to do reduction in forces. Some of these, especially foundations, you're taking on more and more work, but you're not able to hire more people. So people are taking on more and more burden. That isn't only the case anymore. Now we're seeing a lot more burden and burnout taking place at that leadership level, which what happens, it impacts our overall effectiveness of becoming a leader. And again, not only leader of an operation, but remember, a people leader. If I'm burned out, how am I going to help you with your burnout, right? So we're basically, we're creating a bit of a recipe for disaster. And then the last one by Harvard Business Review basically states that 55% of employees struggle to maintain work-life balance, citing negative impacts on personal relationships and professional motivation. So what does that mean? Again, if we look at all of the compounding work, are we really doing what we need to do to provide our workforce with that right work-life balance to help basically manage things at home and things at work? And I think we're going to start seeing a lot more of this trend start to surface. What's interesting about this trend, and again, we'll hear from Robyn and Chaney in a couple moments, about what are some of those more holistic total rewards programs that are being put in place to really address both sides of these. So let's jump to the next slide. So a couple quick themes, and then we're gonna dive into some kind of mixed polls and some panel discussion. But I did want to call out a couple things that correlate back with these statistics that we read. The first one is really a big disconnect between leaders and the workforce. A number of years ago, I would say that and I'm going to use COVID, I know we're still talking about it, but reality is that, especially when we started putting people in a more remote virtual space, or people were having issues in terms of really understanding and belonging and in isolation, is that leaders really didn't have a strong answer for that. In fact, many of them were facing these same issues. But I think what's happening now is we're starting to come back together as organizations, especially looking at how cultures are changing. This is a really big opportunity for leaders to start being leaders again and really start embracing the workforce and taking charge and really having a lot more employee-centric empathy and leadership in terms of their approaches. The second is isolation, right? And this is where it gets very interesting as we look at some of these studies between the remote and hybrid working situations. And I will just be, and some of you can reach out and say that I'm completely wrong on this, but, I read a lot of research and studies, and I don't think there's necessarily any studies out there that say that, work levels have gone down or we have an impact in productivity. But I tell you what we have seen is a much higher level of issues in terms of isolation and belonging from not coming together in terms of an office. Now, what I'm saying is you all shouldn't come together and force everyone to come to work. What I am saying is that I think there's a lot of programs in place that you can start instituting that help create that belonging and connection to eliminate a lot of that isolation for those workers who are remote and hybrid. The next trend I want to touch on quickly is empowering, reinforcing, and modeling work-life balance. I think one of the things that we often forget as leaders is that we have a number of people who report to us looking up at us, and we become their mirror in many instances, and they are a reflection of us. And when they see us coming in and grinding and not taking time off and not doing things for us and our families, they feel like that's the same approach that they need to take. I think there's a lot of opportunity for us as leaders to demonstrate and reinforce the value of work-life balance. As I mentioned earlier, this is a trend that's not going down. It continues to go up in terms of the downstream impacts of not creating the right work-life balance. The question is, what is the right work-life balance? And every individual has to answer that for themselves. but I think I need to be able to feel comfortable and going and seeing from my manager that is a role and a thing that I can do to demonstrate based on how they're leading. The fourth area, touching really quickly, is the inclusion of psychological safety. Psychological safety came out a number of years ago as a pretty big term. For those of you who don't know what psychological safety is, it's basically an employee's ability to provide transparent and open feedback or in discussion to their leader without repercussions. You know, as I mentioned, it was a pretty big trend a couple of years ago. How real was it? I think was really the big question. And this is part of well-being, is being able to, me as an employee, or you as an employer, or you as a leader, to listen and really provide the right guidance and support for your workforce that they actually need. And sometimes these conversations aren't the most comfortable for the employee. And I think this is where we as leaders have the opportunity to provide that open door and really being able to listen to them and not have the employee worry about they're breaching this or they're breaching that, but really be having a very authentic and transparent conversation, which they may need, whether that's about their family, their job, a coworker, their work itself, or whatever. I will say that I think is a major trend that we're seeing, especially within the private foundation space, is around peer support and connections. And a lot of this comes back to a little bit of all of these coming together, right? Which is really how do we create this inclusive, connective type of workforce? And what we're starting to see is a lot of organizations are creating little micro groups, whether those are support groups, whether those are soccer groups, whether baseball groups, whatever, but it's really about bringing like people together in certain scenarios to build relationships and networking so that they feel comfortable and having broader conversations, they feel connected, and they feel as if they're part of something. So a lot of big trends coming out. I probably spent a little bit too much time on them because I want to get to my special guests. But I just wanted to share some of these with you because I think some of these we're going to stay pretty flat and pretty consistent. But I think some of these we're going to continue to see an uptick. And this is really where we as leaders have the opportunity to make a big difference within our organizations. All right. And then, Susan, I will get to your Q&A. All right. Robyn and Chaney, I've been waiting 3 months for this. I feel like I'm on I should come up with my own show, not The View. We'll call it somewhere else. Well, The Vision. How about that? We'll call it The Vision. So we had spent a lot of time together. For those of you on the phone, I've had also the pleasure of meeting both Robyn and Chaney at a couple conferences where I've got to know them very well. But we spent a lot of time prepping for this session. And part of that was me interviewing them frankly interviewing me a little bit to really come up with some of these questions that we're putting in place. So my first statement and question, so it's going to be a quament, Robyn, question, comment combined. Since 2020, the way organizations work has significantly changed. We have also seen an increase in challenges associated with culture, recruiting, engagement, and retention. And Chaney, you're allowed to answer this too, by the way, but I'm going to start with Robyn. So first, what changes and challenges has the Kalamazoo Community Foundation experienced as it relates to culture changes, recruiting, engagement, things like that?
Sure, I definitely could tell. One of the first things that we have experienced as we're talking about leadership burnout is that all of our chiefs, which means all of our department heads, have been working for the foundation less than 1 year. So going through a cycle where your CFO has only been there for 6 months, your chief of strategy and communication, your CEO, they have all been there less than, I want to say, 1.5 years, has been a big culture shock, especially for staff that have been there. So that recruitment factor, one of the things is that we have gone from 33 employees to about 48 employees, within 1 year. So kudos to Chaney, who has did all the recruitment. So I will let her speak about just the trends of recruitment. But we have seen where culture shifts because of new staff, because of staff that have been there for quite some time. So we are dealing with that challenge of how do we adapt and adjust in this fast-paced environment, plus having a lot of different generations within the workforce. But I'll let Chaney talk a little bit about how recruitment has changed for us over the course of the past 3 years.
Awesome.
Absolutely. Thanks, Robyn. Yes, always Robyn first. So yeah, first, just to comment on the culture. So I actually just met with an employee. We do stay surveys with our employees. And one thing she had commented on is how there's kind of a buzz in our office because there are so many new people and there's such a growth mindset within our office and with our staff. But to touch on recruitment, we actually just created a recruitment and bias-free hiring guide for all of our hiring committee leads to use in our hiring committees. So I think first place when we recruit, like we want to make sure we get the right people in the right seats. So part of that is making sure that you have a really good hiring process. So very proud of our team for putting that together. Yeah, and then, I think the next part is I am such a process person, right? So part of burnout and isolation is like, what does your process look like? So you're going to hear me talk a lot about kind of before Robyn and after Robyn. So pre-Robyn, I was doing a lot of spreadsheets and manual work for recruitment. And then she's like, what are you doing? So we updated to an actual recruitment platform that took about 5 hours off of my recruitment time. So right there, I have 5 hours back to engage with employees and touch base with them. So I think that's the biggest thing is actually looking at how you're recruiting and the actual tactical processes just for yourself, right? And I think the candidates can see, if you're feeling good in your job, like they can feel that and they can see that.
One of the things that you both had said that I want to reinforce is when you both talked about culture, you used the words either mindset or behavior, right? And I think it's really important. And I think you talked about the generation differences, the people who've been there, the people who are not. And I think it's really important because often people think of culture as this brick and mortar thing, right? Like, oh, you work here, and it's not about here. It's about culture is about the people. And you're right. It's the mindset and the behaviors that different people infuse into the organization to build culture. And I would say that is just one piece to that is, I think it's one of the biggest challenge areas that we have seen over the last couple of years because of the hybrid remote, in-person, leadership burnout, employee burnout changes is culture has diminished. And you see a lot of trend lines that culture is diminishing within organizations. And it's very refreshing to hear the term growth mindset, right? It's like people are excited and want to learn and want to grow. We should take a big lesson from you all in terms of how to do that, because I think it's a really key piece. So thank you for that. Anything else you guys would want to add on your any challenges with engagement or retention? I'll start with Chaney then. Oh, okay. Go ahead, Robyn.
No, we're pretty much good to go through that process. Okay. I think, we just kind of have all these things that we'll put in place that as we talk and kind of go through this process, you'll hear a lot of the things that have been implemented. And I'm sure Chaney will always go back to where she was a couple years ago to now our introduction into how we've become extremely creative and looking at that whole experience that you hit on a little bit that takes HR just beyond the office and beyond the workforce to really get into the well-being of our staff and making sure that they truly understand the difference of being tired or burnout and how we just continue to engage them to be part of everything that they do.
Yeah, I love the word creative, Robyn, because you're exactly right. There isn't a one size fits all. Right, you do absolutely need to be creative, and Susan, I agree with your comment in the chat. And I think it's important to highlight that is you're seeing more co-leadership at the executive director director levels to deal with burnout and work-life balance. I think it's really important to be able to do that. So thank you for adding that. So our first poll of 6 is, have you seen an increase in leadership and workforce isolation and burnout at your organization? Oh, ABC. I thought I hit the next button. There we go. Noticeable increase.
Sorry, Brett. I'm going to leave this open a little bit longer.
Oh, okay.
And not enough people responded.
I was jumping
yet.
ahead. Sorry. I apologize. I had a quick finger.
All right, we'll do about 5 more seconds here. Make sure to hit the submit button, and then we'll close this out, everyone.
All right. 79% of people. 81. We're getting big numbers.
All right, here are the results.
Awesome. Wow, 45.7% of people said noticeable increase. 10.3% said no increase at all, and then 15%. Yeah, that's pretty big. I mean, I think it's, again, you guys, this is right along with what we're seeing from a trend perspective. And it's, you know, I guess I would love to ask each trying to put it in the chat, like, so what are some of those challenges that you're seeing? So awesome. All right, well, let's go to the next slide. So question number 2, Chaney, I'm going to start with you on this one. A major contributor to the level of leadership and workforce isolation burnout is lacking of understanding and awareness by the leadership team. So this is a 3-part question, so we'll go back and forth. So Chaney, starting with you, how much education do your leaders, managers, and employees have in understanding and identifying isolation and burnout?
Yeah, thank you. Well, they have us as an HR team, so we're very transparent and we're very open when it comes to this with staff. And Robyn had started talking about, are you tired or are you burnout, right? And going further into that, I think it's also like with our new staff and our new strategic plan and growth, like it's really looking into like, what are people's actual roles? Like not having the ambiguity of like, this is what I think I do. It's actually getting really clear on like, this is your role and this is how you're supporting our mission and our strategic plan. But before I go on, I'm going to let Robyn answer on that a little bit more.
Sure. I think one of the things that we tend to do, especially with our leaders, is, again, Chaney mentioned full transparency. And that is a lot of just communicating, being able to be there. We talked a little bit about stay surveys earlier in one of our questions. But one of the things that we truly did create is that we create stay surveys for our employees. You know, we always talk or we hear how people do exit interviews when someone is ready to leave the company. But on a yearly basis, we actually do a stay survey with each and every employee. That is from our top executive level management down to an employee who may be an entry level individual or a front desk individual. What that does, it allows us to really have an understanding or identify burnout. So with that connection in HR, we're always able to give that information back to our senior leadership team. And one of the things that we also do with our senior leadership team is that we will go into their meetings and we give them transparent information about if an employee is dealing with exhaustion, if they're dealing with burnout, if they're having trouble in other areas. We communicate that efficiently, effectively, and right away. I think one of the things that we tend to get away from is that individuals don't communicate enough. Sometimes we'll say, oh, well, we'll just wait to see how it happens. But we're very proactive of making sure that we are always on the front line with our staff members, that they understand what's going on, and our door is always open. So we talk about open door policies, but we truly do have an open door policy to allow them, whether it's to come vent, to get understanding, and also be a part of what we're trying to create. So that way each and every person understands the difference of being burnt out or being tired, or even to the point where they know how to manage and educate themselves on what they can do in order to get to that next step.
Good. Thank you. And I think he answered all three of those questions without me hitting all three of them, which is great. But I actually do have a follow-up question. So this is what you had said was really good for existing leaders. I think one of the areas that we also see some gaps on are people stepping into a leadership role or a manager level role who, up until this point in their career, most likely have had to worry about their own, right, burnout and things. So are there any like training programs or maybe it's just coaching or feedback that you're doing for new managers on identifying burnout or isolation?
Yes. So, of course, I always give this to Chaney because I definitely know I create all of these things and I'm like, here you go. So one of the things that we do, especially with the new managers, we take them really through a process, and that is creating a gap analysis, seeing where their strengths are or maybe where they need improvement. What we like to do with them is also sit down on a 30, 60, 90, 6 months basis as becoming a new manager and supporting individuals to see where they need help. It is getting them to understand accountability, getting them to understand conflict, and also getting them to understand truly what it means to have one-on-ones with their individual employees. So it is about, how do you understand the difference of objective to subjective? Really sitting with them, letting them know how important it is to give that honest and open feedback, and to just make that connection with individuals one-on-one and how important that is. So we create just different items that we will give to them that kind of guide them through this process that we hope help them in the long run.
Awesome. And if you don't mind, Robyn, there are questions coming in, and I'm going to hit some of them as we go through this because I think they're relevant. And I hate to wait to the end and then go back. Well, do you remember what you said about that? So Kristen asked a really good question. Can you talk a little bit more about what you ask
on the stay survey?
Yes.
Sure. So Chaney, do you want to? Because you just did one this morning. So that would be perfect.
I feel like I have it memorized by now. So yeah, it's an in-person sit down, and actually have them in, we use Microsoft Forms, but it's very similar to Google Forms. So that feeds into, an Excel spreadsheet. So that Robyn and I can both view it if one of us is doing that. So first of all, I just like to ask, is there anything you like to discuss first or talk about first? A lot of times it's like, nope, I don't want to. But if an employee is really having an issue, we just stay on that question and that is it. And then, of course, we have follow-ups after that. So that, are there any responsibilities you're unclear of? Let's talk through that. Any tools or resources you need? And then the other big one is, how is your connection to the mission, vision, core values evolved or changed over the last year? And then I do ask another open-ended question at the end of anything else you want to talk about, because sometimes as the conversation is going, more things pop up. And then of course I do have other surveys for new hires that we have different check-in questions for that. And I'm happy to share those if anyone wants those.
Awesome. Thank you. And I think those are really good pointed questions, by the way. And I do like the fact, Chaney, that you said that you don't require them to answer all of them, right? They're really there for them to provide feedback and input, which is good. So thank you for that. So Donna says, I'm calling you up because your name is on here. So, but Donna asks, how do you balance notifying leadership with confidentiality of your staff that have confided that they may be having personal issues?
So one of the things I definitely will tell you that Chaney and I do which is very helpful for us, is that we build that trust with all of our staff right away. When there are personal issues, because we create and we have a hybrid kind of temporary remote situation going on, we do talk one-on-one directly to, I want to say, either their leader or to an individual. And usually it just comes from HR. So say, for instance, I will be fully transparent with everyone. Chaney had mentioned her and I are usually in the same office. Unfortunately, I had an emergency back in Pennsylvania. So I am here in Pennsylvania. So I am able to communicate directly with my CFO, but there's not a single person in the building unless I was willing to tell them, who would know what's going on. The way that we try to keep it is that we make sure that, especially with our leadership, that they truly understand if someone is having a personal issue, you know, they have enough trust in their HR team to know that we are not putting anyone either out of work, in work. We always have confidential information that's never posted online in SharePoint, any documentation as we kind of walk through that process with that employee. We also refer them to things that we have available to them, which is our employee assistance program. So that way we do not intervene in the middle of it. And also we have a great health insurance option that we can provide individuals with that information. So again, one of the things is that if you have that person, and I do understand that some foundations are not always able to have a team full of HR individuals, but that person truly has to be trusted and to be known to hold things to themselves. And the organization also has to trust that they will do the right thing with that person as well.
Thank you. And then I have a couple more, and then we're going to jump to the next poll. And I love this one from Shirley because I think she was talking about me. So earlier I asked you about what are you doing for new managers, and she wants to know about what are you doing about all the long timers who have grown complacent and don't want to change.
Yes. So that is always great. One of the things that I will tell you, it's about looking at your policies and procedures too. A huge part of what we took on this year is that managing those individuals, especially those individuals with 10 plus, 15 plus years in the same position where it seems very redundant. We've also introduced a sabbatical leave policy. This sabbatical leave policy, but it didn't come with just leaving to get rest or restoration, whatever we want to call it. It also came with, hey, do you need to be connected? Do you need to go somewhere to get additional training or any education, or what new would you like to learn? But sometimes it's about putting an individual just in the right place of where they belong. Some people want to go learn about other things, whether it's fundraising, whether it is, marketing and communications. We set up enough programs and we look at enough things collectively, also with some life coaches, that we tend to say, oh, during this time period, what do you need to work on? So I think when they become complacent, we also try to find those things where they want to continue to grow. Sometimes it's not always in that one area. So we work on that and we will provide them with, whether it's a 4-week time period, no more than, of course, 12 weeks, but we provide them with that time period where they can go and they can grow, or they can learn something new, or they can truly get rejuvenated back into their job, where we hope that works for them.
That's great. Thank you, Robyn. Now, Carlinda asked a question, but I'm going to hold on it for a couple slides. So I'm not ignoring you. We're going to come back to you. But Michael did ask if you could either put in the chat, or if we can provide it after the session, the stay survey questions that you asked. That'd be fantastic.
Yes. So we will download just a copy in a PDF, and we'll put that and share that with everyone so they can have it as well.
Awesome. Okay. So polling question 2 of 6. We seem so far away, don't we, Robyn and Chaney? 2 of 6. To what extent do you think leadership at your organization is aware of employee burnout? This is such an interesting question today, especially with all the data and analytics going on. While they're answering this, Robyn and Chaney, I have a quick story. It's actually a long story, but I'm going to make it a quick story because we don't have a lot of time. Is when in one of my prior roles, I was over in Australia and I was meeting with a bunch of clients, and we were taught we called this sentiment. Do you remember that back in the day when I was a lot not as gray, and they called it sentiment. Now, anyways, there was this company. This was definitely not pass here in the U.S., but they had cameras everywhere. And like they would scan their employees, like their facial expressions. This was like I think it was I don't remember what farm tech company. Anyway, it doesn't matter. And like, so they could see when people like didn't have like having a good day and how they were walking, and they basically could analyze employees' posture and correlate it to like a sentiment, whether they were happy, sad, depressed, all these other things. And anyways, and it would trigger notifications to like the manager, like, hey, you may need to want to have a conversation with this employee. It was really, really creepy. But we don't need to get into any more of that. But I just thought it was kind of interesting when you think about predicting, like, you know what I mean? This stuff. All right. 26% are highly aware. 40% are somewhat aware. Our leadership is not aware at all, and then not aware enough. So definitely interesting. And I think what we'll talk about here in a few minutes are some of the practical applications that the Kalamazoo is putting in place. You've already heard of some of them to help bring some of that level of awareness, whether that's that STAY survey or some of the other programs that they're offering to their leadership and their workforce. So let's jump on to the next question. All right. So isolation and burnout result in toxic work environments. Don't you love that word? Toxic work environments that can lead to decreased levels of engagement, poor performance, and significant health concerns. So Chaney, I'll start with you again because Robyn went last, and I'm going to give her a voice break. What are some of the impacts and challenges the foundation has experienced based on the increased burnout and isolation?
Yeah, thank you for starting with me. I always love it when Robyn starts, though. She always has the best insight, and then I put my little 2 cents in, but that's fine.
She's the closer. I'm going to start calling her the closer.
Fine. So really, I just put, thinking through like, and I'm sure a lot of us have seen this, when people are feeling isolated and burnout, that's when you're going to see them missing work, just not coming in or coming in late, leaving early. I feel like that's where I've seen it the most is coming in late and leaving early, and it's hard to get a hold of people when they're just checked out and burnt out. Robyn, would you like to add on?
I think we talk about, one of the things that we see is truly, and this is when you start to see, and this probably answers and piggybacks off of one of the questions, you start to see disengagement. So we talk about decreased engagement, poor performance, significant health concerns. You truly do see that, maybe it's 5 days out of the week, you see a person is not as responsive. I think some of the challenges for us, especially at foundations, is that we are not large organizations with 300, 400 people. So I think those challenges are also, someone on the team may be taking a bigger burden of work. If someone is less engaged, you start to see individuals not really show up for some of the meetings that you would like to see them show up for, or even going out into the community. You don't see them being there like they used to be. So I know for us, the challenges truly would be that connection of that teamwork. Because in a foundation, we know how important that is when you're in a small team, small organizations, that happens all the time. If an individual's truly not there, sometimes it's really hard to get work done. So we have to find ways to bring that individual back so we can kind of increase, the teamwork, the camaraderie, again, the culture. And what can we do to provide that? And how do we work around that? And how does leadership stay fully functional and engaged?
Mm-hmm. I have a question. Well, two things. One is I was reading an article about this. I don't know if it was preparation of this session or another session, but it was also talking about, why people join, foundations and not-for-profits and all these things. And a lot of it is because they really feel there's a connection with the culture, a connection with and one of the things they were talking about was very similar to what you just said, Robyn, which was they seem to become disinterested in really supporting the mission. It's like it becomes more of a task than a passion, and it's almost as if people kind of get in a sense of depression, in a sense, they're just kind of going through the motions. But one of the follow-up question that I had for you, and then I'm going to go to Carlinda's question, which is really around the toxic work environment, especially to your point. I mean, a lot of the private foundations and aren't sitting there with 300-400 people, right? And so you pretty well know who your colleagues are, and you can often track toxicity, in terms of who becomes that hot pan, if you will. I'm trying to be nice using that analogy, that you want to cool down a little bit. So, the question I have for you is that, what in your experience, like what have you all done when you have started to see a toxic situation rise and you've been able to diffuse it? That's a tough question right there.
Wow. I think, Chaney and I, if we were sitting in the room right now, you probably would see beyond chuckles and laughter. Because, of course, one of the things that I will say is that coming from Philadelphia, it was not an easy transition going to Kalamazoo, Michigan. There was this thing that I truly did not understand, which was called like Midwest nice. That I was just like, what is going on here? So I would say, for me in the last 2-3 years, I am very transparent. That was not an easy thing that we would kind of go through and walk through. But now, as you see, our culture is developing. When Chaney talked about, just that, I want to say that spirit around people just wanting to be open, wanting to be honest. When we would see that toxicity, I tell people all the time, we are all part of the culture. So sometimes we have to pull a person aside to truly be honest with them, to say, hey, that wasn't the best thing to say. Hey, you might want to rephrase that, or are you okay? And this is actually part of where I think the question is being asked, how do we support our peers? Because of course, sometimes burnout can come with toxicity, because toxicity can turn into anger. Although we still support, the core values, the mission, the vision, sometimes I think that's where we are. So in hindsight, what we have created also, I think, are kind of peer connections very early on when new hires are there. Or we've created these individuals where, hey, this is almost like your support person, where people can go and they can talk to, whether it's good, bad, and that's their private conversations that they can have in order to support each other and to represent one another. I promise you, they're not my dogs. So
they're mine, sorry.
Okay. But I definitely will say, I think it's just that having that connection with an employee. We know which employees connect the best with other employees. So Chaney, if you could actually talk a little bit about, we use a tool called Pondera right now. And what that does, it allows us to see employee personalities and work through personalities. And Chaney is very great at that with employees, especially within their own departments, of connecting people who work best with them. So Chaney, if you could just talk for a quick minute about that, that would be great.
Yeah, absolutely. And just to add on to what you're saying, I love Brené Brown. So clear is kind. And as Robyn had mentioned, if you build that trust and that relationship, it's a lot easier to have those conversations with staff. Like these toxic situations, they don't have to be difficult conversations if you already have that relationship, right? So that's part of like the Pondera. It's very similar to like a Strengths Finder or Myers-Briggs. Like at the end of the day, I feel like they're all like very similar and the same. So we utilize Pondera. It's a local. It's just like 45 minutes from here, from where it was created. But yeah, all staff will take the assessment, and it really allows them to advocate for themselves. So it's not so much about, oh, we got to learn everybody's style, but it's like, hey, like you told me, you asked me this question, can you email me, right? Like just sharing with others your style and your preferences. It's not an excuse for bad behavior because we can all do these things, but it just adds that communication tool. So we do that. We meet with the employees with that. And then, of course, we have team sessions. And sometimes, like, if there is a situation that's really hard, it is really easy to just say, hey, you know what? I think we just need to have a Pondera session and sit down together. So, so I've really enjoyed using that tool with staff.
That's really interesting. One of the questions that Carlinda asked, and I want to kind of hit on this because I do think this is one of those sticky conversations, which is managing up. You know, I talked earlier about, you know, we're starting to see psychological safety being included a lot more in organization. Let me rephrase that. We're starting to see the term psychological safety and the practice of psychological safety being administered more, respected more, and really implemented in a way that it's not just a term, right? And a lot of this, I think this comes back to that Carlinda's question regarding managing up is, you know, what are you doing for an employee to feel safe to go to your manager? And Robyn, basically say the same thing that you mentioned. Instead of pulling the employee away, maybe the employee goes to the manager, say, you know, I think maybe next time you need to tone that down a little bit. You know, it may have been a little bit harsh or a little bit offensive or something. So I'm just curious if you're putting some of those practices into place as well.
Yes. So what I think I love the most is that we truly have support from our CEO, and our CEO truly does push the fact that HR cannot create the culture all by ourselves. We truly look at making sure that, I want to say, leadership, where we have two roles of leadership. So you talked a little bit about co-leadership earlier, where we have that co-leadership, but it's truly with our senior leadership team, we equip them with the tools. So one of the things that we have rolled out, especially for 2025, is that each and every one of our senior leadership members will be going through kind of like a one-on-one session with HR. And this is going through everything from, I want to say, our handbook that we have now changed the name. Instead of having a normal handbook, we have what we consider as our culture guide. And through that, we take them through what's the processes of understanding your staff member, what's the process of being able to communicate effectively and efficiently with your staff members. These are all the things that we truly want to make sure that we can live into each and every day with that person. But it is also getting our senior leadership to understand that we need their support, because we can't be the eyes and ears through every single function. And so being able to pop in with them, having that one-on-one 30-minute, 15-minute quick conversation with them also brings in a lot of that, hey, direction, where they have to take the accountability to make sure that they are approaching their employees as well.
Yeah, and if I can just bounce off of Robyn to just for staff going up to management, like I think leaders need to be accountable for that and the culture they create. Like I 100% can go to Robyn and say, hey, you did this and I don't like it, right? Because she has created that trust. Like I know she's got my back. She's not going to be upset with me, right? But not all leaders have done that, right? So I think leaders have to put in that work. It's not just going to magically happen.
Yeah, I think that's important, right? And I think, Robyn, you said this earlier, it's around accountability. You know, you've got to drive accountability for the leader. I mean, ultimately, right, HR I always, people ask me, what's the difference between HR and a leader? I mean, HR is the stewards of the workforce programs and processes and the technology. Like we have an owner that we enable the organization to manage their people effectively, but they're not our employees, right? And the managers always are coming to HR saying, I need you to do this for our employee, but it's your employee. So it's a really good point. I'm going to jump to the next polling question, which is poll 3 of 6. What are the impacts you have seen from leadership and workforce isolation and burnout at your organization? Increased turnover, decreased productivity, decrease in collaboration, and no impacts at all. I do like the culture guide too. I got to ask, Robyn or Chaney, who came up with the culture guide name?
So she looked at me and said, we got to have this.
So I tell Chaney all the time, one of the things is I get these weird things that I want to do, like in the middle of the night. And when I always come in, so this is part of knowing your employee. I always bring her in. She loves these almond croissants from a bakery. So when I have all of these like wonderful ideas, I bring her in an almond croissant and it is sitting on her desk waiting. So she knows that means that somewhere between that 4 or 5 o'clock hour and whatever happened at 7 o'clock in the morning, that I had an epiphany and woke up with all of these wonderful ideas. So really, it was just a collaboration of looking at, handbooks tend to be very boring for a lot of people, and they're so redundant. And we were always trying to figure out, how can we get people to truly read something that's out there? How can we start to get people to not always have to come to us, but always be self-sufficient? So I came back, talked to a few other people. We talked about culture guides and we changed it. And I bought Chaney her almond croissants. And I was like, we have to do this. So, and that's funny. Where we are.
That a dozen almond croissants later, and you're going. That's awesome.
I can do both.
So
yes,
yeah, 36.7% turnover, 30.6% decreased productivity. That's really telling, actually. And if you look at some of the market statistics, I mean, it's pretty on spot. But that's a lot of turnover. 36.7%. I mean, not that that's the percentage, but I mean, a lot of these, the 36%. That's a pretty significant number. Interesting. All right. So, 2 common themes associated with isolation and burnout are mental health and well-being. I mentioned those really early in the overall introduction. So what I'd really like to dive into is some of the programs that Kalamazoo is putting in place, or has put in place, or will be putting in place, as regards to supporting mental health and well-being. I'm not gonna call on either one of you. I'm gonna let whoever jumps in first.
Would you like me to jump in first, Robyn?
All right, go ahead, Katie.
I'll do it. I'll volunteer. So just to start off with, of course we have an EAP, so Employee Assistance Program, and we get utilization reports, and staff have loved that. So that's one thing with programs is we love being able to get reports to see like if staff are actually using them. And then I feel like part of well-being too is, of course, like what are your medical plans look like, right? Like we have a very rich medical plan that we pay the premium for our employees and fund part of the HSA for, right? And then another part is we also initiated a wellness stipend this year. So staff can receive a stipend to use for whatever wellness they want to use for the year. So those are just a couple of them. Robyn, do you want to hit on a few others?
Some of the other things that we can talk about, even when it comes to support of our mental health and well-being, is that we've truly taken a look at our policies. So I would tell you one of the easiest policies that I could say had to be is that when we talk about mental health, when we talk about well-being, is that we have truly stretched things beyond just, our every daily day-to-day. But we've also looked at policies like our bereavement policy. So just for an example, we realized that family is so dynamic and different at this day and age that we've added on a few things when it comes to mental health and well-being, that stretching the days a few days. You know, people had that, oh, you can only have 3 days if this person, but we realized that that is just not, that's not feasible to do in reality. So we've stretched those days. We also realized that family is different. People consider other additional family members or friends as, brother and sister, aunts and uncles, grandparents. Even knowing that if someone doesn't have family, that we've even stretched our bereavement policy beyond just considering, our human friends and family, but we also look at our pets as well, because we realize that people hold that near and dear to their heart. So there's a lot of things that we are trying to do to support that. One of the other things that I could say is that we saw this frustration around when we all knew that that individuals were going to start, I want to say, that stress around, oh my gosh, what am I going to do when individuals needed support? I want to say when loans were no longer in forbearance after COVID. We actually expanded our education policy to support individuals when it comes to the repayment of their loans, where they had the option of education assistance for, college or certifications. But it was also now where we expressed that to say, man, we don't want you to be stressed out about maybe a loan repayment. So how do we expand that education assistance policy to make sure that we're not only looking at your day-to-day, but we're also looking at your social impact and how that affects you. So even to the point of our social impact, we opened our EAP program to the fact that, if it's a close family friend, that we have individuals that can use that as well when it comes to that one-on-one of just being beyond. We hear the thing about, we really do want to create the culture of HR beyond just the workplace, and also know that we have the social well-being impact of it as far as the mental health and the day-to-day well-being as well.
Mm-hmm. You said the word stretch, which made me also want to put forth our schedule. So this year, all year round, our Monday through Thursday, our staff work 8 to 5:30, and then Fridays we work 8 to noon. So staff have really liked that, right? So they have Friday afternoon to, if they need to make appointments or do whatever. And of course, we still have a flexible schedule, but it's really nice knowing like no one's going to be calling me after 12 on Friday, right? So yeah, that's been wonderful.
Yeah, that's really interesting. What's funny is, well, I want to ask a question. And so when you described your EAP and some of these other programs, how well versed do you think your leaders are about them and your employees? How knowledgeable are they?
I think that's, you want to know, and that's one of the things of, hey, where we're like, oh, this culture guide is great. We felt like, you can introduce them, you send them to them, you put them in an HR newsletter or maybe a daily newsletter that's through the senior leadership team where we're giving something once a month. But what we realize is that people only read things when they need it. So, creating this culture guide has allowed us to really sit and be able to manage through this process. I think with our employees, what we are doing is specifically setting up these lunch and learns that I not only give, hey, here's what's going on in this department, maybe that department, but we are setting up lunch and learns to truly go through our culture guide, to get feedback from the employees, to talk about resiliency. It's not only just for the benefits of, oh, here's open enrollment or here's your 401k items that you do, but it is really opening it up to be able to have those quick feedback sessions, whether they're 30, 45 minutes with staff, so they can truly understand all the things that we're trying to put into the organization, and letting them know that we hear them, we understand them, and we kind of go from there. So I do know, as we talk a little bit about, but one of the things I would have to say is that every year we also do a pulse survey at the end of the year. People don't understand how important pulse surveys are. And again, pulse surveys are, what about your retention? Again, it talks a little bit about, do you feel like you're being heard within your organization? Do you feel like there's work-life balance? So getting those questions back at the end of every year also lets us know as we go through and we create these other policies and procedures and the things that we're doing, it also allows us to evaluate. Are we getting it right? Do we need to do it over? Do we need to be more creative? Are we taking HR beyond just what we have internally and making sure that employees know externally we also support that because we want them to come to work every day in a great mood, or we want them to know that they can come to us if something is going on that we can help or assist with.
Yeah, that's great. It's as you're talking, and I'm digressing for a second, but that culture guide to me, you probably are in pieces, but it's almost like a great recruiting tool as well, right? To really help a potential new hire really understand the value proposition of coming to work at Kalamazoo. Here are all the things that that we offer. So just an interesting thought. So let's go to the next polling question. 4 of 6. We're over halfway. How effective is your leadership in addressing workforce mental health and well-being? As you were talking, Robyn and Chaney, it's so funny. A lot of times we talk about kind of the recruiting piece, the employer value proposition. And I've been in a couple sessions where I'll basically ask people, like, why do you work at your company? And people are like, oh, culture, or pay, or benefits. I'm like, well, everyone else has culture, pay, and benefits. So some are better or worse. But what really differentiates your business, And I think what's really interesting is as culture guide is that employer value prop. It's here's all the things that we are investing in you to be a better employee and to meet your needs, and it's such a powerful tool to be able to do that. And you'd be surprised at the number of companies who are like, they just sit there and look at you, kind of like a deer in headlights. All right, let's go on. So how effective is your leadership addressing? Let's see. So slightly effective at 25.6, moderately effective, 45.6, not at all, 8.8, and highly effective. Oh, that's not horrible. That's not bad. I do think that the piece here that you mentioned very early on, Robyn, is that your CEO was very highly engaged in this process. And I think that any of these we kind of were talking about in the last question is, your leadership plays just a critical role in being able to articulate these things. That's the difference between what I would call an employee-centric leader and an operational leader is someone who really is listening and caring about your employees. And that person should know about these and being able to help reinforce them and motivate employees to do these things. All right, let's jump to the next question. All right, so what do you think are the most impactful culture changes foundation today based on all of these initiatives that you've been putting in place? It's a big question.
Would you like to start, Robyn?
Sure, I could definitely start if you want me to. I do think that the most impactful cultural changes that we have made, and I think Chaney hit on that, is just that employees were just so elated when we changed a lot of things when it came to a lot of our policies. It was that open door. I always say if you sometimes, and not always, but you may have been that parent that had like that house where all the kids will come in and hang out and do certain things. I can remember coming into the foundation where HR was not that house. And then quickly we became that house where all the people wanted to kind of hang out in HR and come talk and be that way. So for us, the changes dealt with people just being able to feel open, people being able to feel connected. The new behaviors that we see and that we reinforce with our leadership is that when we see employees are just, elated to be there, and we see employees wanting to be dynamic and be developed, it's like, let's keep that going. Let's keep those things going. Let's start a development process. If we have an employee who may come in as a coordinator or a lower level manager or entry level manager, and they want to, take charge of their career, let's start some work gap analysis to see where they need leadership guidance. Let's put them on some coaching tools. Let's partner them up with someone else. So we've seen just this shift in individuals truly wanting to be a part and to live in to the core values and also just be part of that mission. And I know for me, it feels good to keep seeing that go on. So, I mean, Chaney, if there's something else, then, you can add to that.
Absolutely. Thank you. Yeah, I'm like, oh, she hit most of my bullet points. So I'll just reiterate, I think taking out, and we mentioned this before, ambiguity within their roles and adding more clarity. I've definitely seen with staff, like, they want to develop in their roles. They want to grow. And once they've developed in their roles, like, okay, how can we help you develop into the next? So, and a big part of that is leadership, because we've had a lot of new leaders, including Robyn. Well, you've been here longer than most of them. So, right, having that new leadership that helps staff with that, with their role clarity.
Okay, awesome. What about, before I go into the poll questions, some of the common ones that I've looked at were around, you talked about transparency. What about empowerment and modeling? So really thinking about the leaders, empowering the leaders to really model the right behaviors for their employees. And again, I go back to the whole wellness and well-being piece, right? It's a lot of times, especially younger employees coming in or new employees coming in, they're really not sure how to behave. And so they often are looking at their leader as a model in terms of, can I take days off? Do I leave early on Friday? What does flex scheduling really mean? And are we really helping them, leaders, establish what a true model would look like? I don't know if that's anything that you all have been, yeah.
I'll start. So I'm going to tell a Robyn story. So we do this to each other all the time in the office. She's constantly like, well, I'm going to use Chaney as an example. So I will say the first time I ever had a vacation without working was last year. I've been in HR for 11, maybe 12 years. I'm not sure now. So the first time I've ever had a vacation, and she modeled, I called because I think it was a payroll. And she's like, what are you doing calling me? Go back to the beach. So I think that was super impactful for me because Robyn knew like everything that needed to be done from my plate so I could go and enjoy that time away. So I think that is a huge thing, right? We hear about people setting boundaries. Like it starts with the leader. So I'm super grateful that she was like, why are you calling me? Hang up the phone, right?
Awesome. All right. I have a really brain buster question. Hold it till after this poll. So let's jump to the poll really quick. So 5 of 6, almost there. What types of leadership behaviors do you believe could reduce leadership and workforce isolation and burnout in your organization? I think you heard every one of these from Robyn, Chaney, but we want to hear from you. I feel like we need some music. I should have brought a guitar. Or a little flute. What's the little thing you go, not the flute, but the one you learn how to play in elementary school? You know what I'm talking about?
The recorder.
It's that little, the recorder. Yeah, I could never do that. I got
Not
like
sure
neat fingers.
it sounds so great.
I can't. Yeah, no, they don't. But like I hit one and hit like 3 holes at the same time. It was boom. It was never good at it. All right, let's see. Active listening, awesome. Empathy and emotional intelligence, which is great. Transparency communication, that's a big one. And then recognition, support, and empowering modeling are close to tied. Fantastic. All right, I'm going to go to the next one, but I'm going to go to the next question first. So before I talk about strategies, programs, and process, because we've already talked about a lot about those, the question that came in was, does cultural change include strategy changes so the organization is doing fewer lines of business rather than trying to do everything and be everywhere to everyone?
Wow, that is an amazing question. And what I can tell you is that
I told you it's amazing. It's a brain buster.
Yes, I know. These are really great. But part of our cultural change truly was a strategy change. It was clarifying some things. And I think that's where it doesn't mean that it has to be an overall haul of where we are, but I think it's about clarity. So one of the things, and Chaney will definitely say, and this doesn't happen whether you're getting a new CEO, whether you have a phenomenal CEO, which I know a lot of people have, but it's truly about making sure that people understand what the strategy is. So for me, I went from an organization here on the East Coast where the strategy was clear. You know, here were our pillars. Here's what needed to be done, because of course we realized that we can't be everything to everyone. And then I came into an organization where I felt like, hey, it wasn't certain. What is our strategy? So I do think that when you clarify strategy, you don't necessarily have to change if you have that strategy plan, but I think it is the clarity. So when you took the poll and everyone talked about transparency, you know, and being upfront, that is the clarity of the strategy that people truly need to understand in order to continue to move that culture forward. That way, because we know we can't be in every place at one time. It's almost impossible. So again, if you could do that, that would be great. Just making it clear.
Yeah, I think the only thing I would add is just allowing people to be experts, right? Like allowing people to be the experts in their role and to live into that. So.
Wasn't there a phrase, and I'll probably get this wrong, that culture eats strategy for lunch? You ever heard that phrase? And I actually don't believe it's been ever quoted. If you look it up, there's like 6 different people say they said it.
There's 6 different versions of it, yes.
Yeah. But I do think it's really, it's an interesting statement, right? Because you can have the best strategy in the world, but if you don't have the right cultural attributes, the values, the people, the mindset to execute that strategy, then it doesn't matter. You know, and I think it's a really, you know, to me, I think it's a really great question that was asked. And it's such a powerful thought behind that is, yes, I mean, I don't think you build a strategy around culture, but you got to have a strategy that's enabled by the right culture, you know, to be able to deliver it. So, all right. Thank you for answering those. Any other areas that you all at Kalamazoo have been focusing on that you want to raise, that you've been just dazzling the organization with as it relates to mitigating any of those engagement risks, retention risks, any of those things, isolation risks?
So I would have to say it's definitely been a mixture of everything for us. You know, it's really not one thing. If you hit on that, but it's really, it was a, you know, how do you come in and make sure that all of your employees know that you could be supported? All of your employees know that we are transparent, and just making sure that they truly understand that all of these changes that we are putting in place, that we are looking at not just one person, but we are looking at the entire, you know, everyone in its entirety. And if I could say, every year we have changed our pulse survey since I've been there over the course of the last 3 years. And I think for us, we just see the difference of it being better and better. The other thing is that you hit on different groups. If your organization does not have groups that support one another, I strongly encourage you to support them, because we have affinity groups. And of course, these are groups that are, whether it's a Pride affinity group, a Hispanic affinity group, it's a Black affinity group. We allow people to go into those places to be in their spaces where they feel somewhat soft. And they feel encouraged with one another. So if you ever want to take a look at that, we strongly encourage that that's things that you can put in place as well. And of course, I know our information is shared. We have an HR mailbox, but if you're ever interested in anything, Chaney and I are more than welcome to always continue to share.
Awesome. Well, thank you both. I'm going to go to my next poll and the final poll. All right. This is for our audience. What strategies have you implemented to leadership and workforce isolation and burnout? Education, rewards and recognition, flexible working, communication, interaction, or other. The other you can put in the chat. And I think we're just about out of time. All right. 51.9% said flexible working and remote, 22% interaction and communication, 3.2% other, and then interesting, 13.6% is only rewarded. And look at the low education. I find that very fascinating. I would have actually expected that to be much higher. I thought that was really interesting. So let me check really quickly, Chaney and Robyn, see if there's any other questions. One person said the other is executive sponsorship, meaning if management doesn't support a deliverable, it's not fair to make me be the heavy. Well, that's a good one. Okay, thank you. You're welcome. And regular salary increase and flexible working, an encouragement to use most and all of the PTO. Okay, that's a good one too. Fantastic. Well, we have a couple minutes left, so I'm going to open up any other questions from the audience. Or I can definitely tell another story because I have thousands of them. You know what word we did not use this entire session, Robyn and Chaney? Artificial intelligence. All right, let me go. Go ahead.
Please, no. We're like, woo, wait a minute.
That's right.
Wait,
we used enough
this?
buzzwords today. I think we used all the 2024 HR buzzwords, and now we're throwing in AI. I just wanted to use it just so we could wrap out the.
Everyone can simmer on that before their next
That's
session.
right. That's right. How to use AI to mitigate leadership and workforce isolation and other things. So, Amy, are we okay to pass it off and give people a bit of a break?
Yes, we are.
All right.
So,
well, let me just think. Can I thank Robyn and Chaney first? Both of you, thank you very much for your time. It's been awesome to have you on here, and for taking the time to share your insights and input. And thank you also for your openness for if people want to contact you to that they can do so. Oh, we have a
nice, Michael.
Thanks, Michael. All right, I think that's it. Back to you, Amy.
All right. Well, thank you to all of you for your time and for the great discussion. And then to our audience, this concludes the morning sessions. Join us for the afternoon sessions starting at 1 o'clock Pacific time. And to get to those sessions, you're going to click the widget located in the upper right-hand corner of your screen, or you can use the login link that was emailed to you when you registered. It's also in your calendar appointment, so plenty of ways to get to the afternoon sessions. And thank you, and enjoy your break, everyone.